morning, one and all present here. And now we will write for a motto song and then we will start a session. A short introduction about Sir. Sir, Mr. Chinnaswamy Ganeshan has started as Chartered Accountant in 1988 and Sir is presently a senior partner and a head of auditing and assurance of firm for 10 partners and around 120 members are there in his firm. So Sir is specialized in financial reporting, company laws matter, auditing and taxation, and is a recipient of the Jewel of India Award for his role in financial service and Certificate of Excellence for his contribution in the field of financial service by the International Business Council. Ganeshan Sir has presented 850 papers at various seminars, workshops and conferences in India and overseas on these specialized subjects. He has assisted 61 plus companies on Ind As transition. So Sir's specialization, he has authored a quick reference on IFRS with modeled question papers. Sir is closely associated with Institute of Chartered Accountant of India and is guested faculty for all its 5 regions council. He is presently a co-opted member of the Accounting Standards Board of ICAI and Ind As Transition and Facultation Group. He was a co-opted member of Ind As Implementation Committee of ICAI. So Sir has participated in a lot of institution activities and I would likely to invite Sir to the podium and start the session.
Good morning. With the requirement of CPE catching up and also the complexities of these 2 standards becoming a worry for the corporate world, I think the right topic has been chosen by the SARC of ICA. My sincere thanks for the opportunity extended. Let me just make this as a interactive session rather than just pouring off my thoughts on you. And whenever we have some case studies, let us take your views also and then we will deliberate on that particular point of view. Let's just take the agenda for Ind As 115. What is new compared to our existing standard on revenue recognition? That's what we will discuss first, because we know what was there in IGAP AS9 as well as what is there in Ind As 11 and Ind As 18. Ind As 11 is on construction contract and Ind As 18 on revenue. Both the standards have been repealed and we are having Ind As 115. Let us understand what is the difference compared to what we have already learned and experienced and implemented over a period of time. And this standard is talking about a 5-step process. We will try to understand each of the steps. If we understood the 5-step process, then accounting as per this standard is very, very simple. It's not complex. But in each step, there could be some sort of practical issues which we will discuss those practical issues as well. And of course, what is the case studies relating to these issues and what has experienced in the last 1 year, because the standard has been made applicable for accounting period commencing on or after 1st April 2018. That means 1 year of experience we are already having in the implementation of this standard. And to that extent, if any new client is now going into Ind As based on maybe the net worth of an NBFC or based on the net worth of a non-NBFC, first time crossing the threshold limit of 250 crore or 500 crore, or a company which was unlisted before now become listed or proposed to be listed. So whenever we are applying the standard on a new basis for the existing companies who are going to join in the bandwidth of Ind As, then we have to understand what is the issues which we have to handle. That experience will also come out by means of some case studies. That's the way in which I have structured 115. After we complete 115, we will discuss about 116. What is new? If you ask, the first question is, previously we had two standards. Even in accounting standards, IGAP, we have two standards, AS7, which is talking about how a company involved in construction of an asset based on the construction contract with the customers has to recognize revenue. That is AS7 is talking about. Equivalent standard under Ind As is Ind As 11. It is also talking about construction contract. There are no major differences between AS7 and Ind As 11. Similarly, we have AS9, which talks about revenue recognition when it comes to sale of goods, sale of services, interest, royalty, dividend and other incomes, rental income, etc. That it actually talks about in AS9. Similar to that, we have Ind As 18, but the Ind As 18 has given something more elaborate compared to AS9. So that is what is an important point which we have to consider. From Ind As 18, we are having Ind As 115, and Ind As 11 has been merged with Ind As 115. So we have to understand simply that this standard talks about accounting for revenue if a company is following Ind As from the accounting period commencing 1st April 2018. That's what I have said. We have 1 year of experience. And based on that experience, I have seen from published accounts that what is the required accounting policy, disclosures, etc. is not very matured compared to what was expected by the standard. We will discuss about what is the shortcomings which we have observed over a period of time and what we wanted to make a better presentation in the coming year. Even when I have advised to certain clients, we have made some sort of we should admit that it is not a complete accounting of Ind As 115. Maybe a disclosure was not fully done. Now, elaborate disclosure is will be done based on the experience which you have gained over a period of time. Because the first company for which Ind As 115 has been implemented by us, it was reporting its financial statement on April 10th. So you know pretty well, April 10th means majority of the companies may not have completed full financial statement as per Ind As. So guidance is based on what our understanding, what our learning, and what was being done internationally. But internationally also there is no guidance available because this standard was made applicable from 1st January 2018 by means of IFRS 15. So up to December 2018, some financials might have been available in public domain. So with those experiences, the first implementation is not very great implementation. Some sort of disclosures and reporting was missing, and later on we have developed over a period of time. When we have advised some companies who have it's unlisted companies who are presenting their financial statement by August, we have matured. So those evaluation in the over of period of time in the presentation, disclosure and recognition we will discuss as part of this session. As I have said already, this becomes a single standard for revenue accounting, and accordingly the existing Ind As 11 and Ind As 18 is no more applicable. Though they have been removed totally, they have been repealed. If anybody is reporting on, even now I have seen 31st March 2019 accounts, some of the accounting policy relating to revenue recognition is still written on the same old basis. That is what Ind As 18 was talking about. People used to say uh, revenue from sale of goods has been accounted when the risk and rewards of ownership has been passed on to the buyer, which normally coincide with the transfer of goods. So this risk and rewards is not the basis for Ind As 115. And what we are following earlier, we are simply copying and pasting the accounting policies in the current period also. Right from the accounting policy, we need to change ourselves according to Ind As 115. That is what the issue, because the two standards have been repealed. Another issue which came is that this standard also covers the revenue to be recognized by real estate developers. When we say AS7, we are talking about construction contract. That means somebody owns a contract and you are entering into, somebody owns a property and you are entering into a contract for construction of an asset. Or maybe you are constructing a property plan equipment as per the designs and specification given by your customer. All those things are part of your construction contract. But if somebody, I'm just taking an example. If somebody is owning a land and his business is to develop a commercial complex or maybe to develop a residential neighborhood with 150 flats or something like that, for them we don't apply AS7 because it is not construction contract, because I don't enter into a contract with another person for construction of an asset. I develop my own real estate for which I am identifying a customer. So the real estate development is not part of AS7. It is not part of Ind As 11. So it came by means of a guidance called a guidance note on real estate developers. That was a guidance note issued by Institute. Even when Ind As has been implemented, we have not borrowed the entire theory with, there is a interpretation in IFRS which says how the revenue relating to real estate development has to be accounted for. If we apply that theory, majority of the real estate companies has to recognize the revenue only on completion of the entire project. Till such time it will be work in progress. So we felt that this will have a big impact on the real estate sector, especially real estate developers. So we have concluded that we will still continue with the guidance note on real estate developers. This was the position till such time Ind As 115 has been implemented. That means revenue as far as the real estate developers for Ind As companies till 31st March 2018 has been done as per the guidance note and not as per Ind As revenue and recognition principles. Now from 1/4/2018, when Ind As 115 has been implemented, the Ministry of Corporate Affairs and the Institute has felt that there is no requirement to keep a separate guidance note for real estate developers. They have scrapped the guidance note, or otherwise they have withdrawn the guidance note. That means even for the real estate developers, they have to recognize revenue only based on Ind As 115. What is the difference between these two? As I have already mentioned, when you use the guidance note on real estate developers, it says if the construction cost incurred crosses 25% of the total estimated construction cost, you can apply percentage of completion and recognize your revenue. Whereas this standard, when the guidance note is withdrawn, this standard has given a guidance on when you have to recognize revenue. It says revenue can be recognized at a point in time or over period of time. When I am saying over period of time, it's more or less equivalent to percentage completion method. In over period of time, it has given only 3 scenarios where it is possible for a company to adopt over a period of time or percentage completion method. If we really put a real estate developer's case into that 3 scenarios, it is very difficult to conclude that all the contract with the customers entered into by a real estate developer may not meet the recognition criteria of over a period of time. That means the entire revenue has to be postponed and recognized only on completion of the project or handing over of the flat to the customer. So this is where the real estate sector is really worrying about this particular scenario, and people are started thinking about whether we have to revise the contract with the customers. That is another reason why it has to be done. When we were discussing with one of the real estate developers, what they have mentioned was that changing a contract may be a challenge for us because of RERA, Real Estate Regulations Act, which has came in. So to that extent, within the parameters of RARA only I can change the contract, and RARA gave lot of powers to the buyers rather than the developers, and to that extent I cannot put a condition by which I will say that I am having a control over the development in progress, and to that extent it will not be matching to the principles given in Ind As 115. That is another challenge which real estate sector is facing. In fact, real estate sector has estimated, one of the giant real estate developer has estimated that real estate sector on adoption of this particular standard in phase 1, that is 2019, will reverse a revenue of 20,000 crore of rupees, which has been already recognized based on percentage completion, because it is not meeting the recognition criteria of over a period of time. That's the biggest challenge which this particular sector is having. And this standard is not giving any transitional adjustment. It's only saying that how you can recognize this revenue. Maybe you can do a retrospective adjustment, or you can do a modified retrospective adjustment. It only gives the two options. So to that extent, there could be a challenge on how the companies will prepare and present the financial statement as per 115. As I have said, if you are still saying the risk and rewards of ownership being passed on from the seller to the buyer is the point at which you will recognize revenue, that principle is covered only by Ind As 18. Ind As 115 says it is no more the basis for the point of recognition of revenue. That means it says that you have to actually look into the terms of contract entered with the customers, and what is the promises you have given to the customer. When we are using the word promises, the technical word used in the standard is what is the performance obligation you have entered into with the customer. So if I have entered into a contract, for example, let us take an example. The company is an Ind As company. That company is in software development. It gives a license for usage of the software. When the license is being taken by the customer also wanted a customization to be done to meet his requirement, because it's if you are just taking a license and started using it, it's like cutting your leg in accordance with the size of the shoe. So they wanted a customization of the software to ensure that it meets their requirement. So customization. When the customization has been done, so far I have used, assuming that, Tally for my accounting, and I am going for an ERP model. That team, the finance team and other teams which are involved in the entire operations of the company require some sort of training. So the software vendor also says that, okay, we will also train your team, and we will take the training in two phases, phase 1 and phase 2. Phase 1 is awareness, and phase 2 is after implementation we will give some training for you, and as like a hands-on. And the company says, which is purchasing the software, says, it is not enough for me to give just a training and license and customization. Maybe for the next 1 year, we need you to handhold our team. Whenever there is an issue, you should be able to support us. So 1 year free maintenance, like a warranty being given for a product, you give us a maintenance for 1 year. Whatever question comes in, you set up your team who can guide us. So all this is bundled as a single contract, and they say that the total contract value is 10 crore. Let's assume this. So what we have to identify according to this standard, you have agreed, or the terms of contract with your customer is to give them an IT support by means of supplying the license, customizing the software, giving them a training, and also to support for the next 1 year. So you have actually given 4 promises of sale of goods and sale of services, or I should use the word, you have agreed for 4 performance obligation in the terms of the contract. And if you say that 10 crore which I have decided as a consideration for this contract is nothing but for sale of my license, you are not allocating anything to the customization which you have done. Assuming that, okay, I have allotted some portion for the license based on what is the normal license what is the selling price of the license to the normal people, and I have also identified what is the total efforts required for customization, and I have allocated a portion of that to the customization work. But I have concluded that the training is free of cost as a gesture to the client for giving a big contract. And the 1 year maintenance which I will be doing is also free of cost, because it is like any warranty which I am giving. So to that extent, I believe that the transaction price is attributable to only two work which I am going to do. One is giving the license and another is doing a customization. And when we are talking about the way in which we are doing the revenue as per IGAP, we consider that the transaction price is only for two, others are being given free of cost, and since it doesn't have a value, we could not recognize any revenue out of it. But when you come to Ind As 115, since you have promised for performance obligation, what is the individual selling price of those performance obligation? Assuming that a customer who has already purchased the license wants 1 year maintenance, and what is the charge which you will do? What is the selling price for that? Suppose if a customer wanted to just have a training before he buys your license, the initial pay is to create an awareness about this, and you have a selling price for that particular service. Ind As 115 says for the total transaction price of 10 crore has to be allocated to all the performance obligation in accordance with their individual selling price, and the revenue should be recognized based on when you are actually performing or actually completing the performance obligation. Maybe it is completed at a point in time, or it is being done over a period of time. If it is done at a point in time, for example, sale of license, it's happening on one particular day. You recognize the moment you have transferred the control over the license to your customer, because that it says that transfer of control is the driver for the purposes of deciding whether the revenue should be recognized at a point in time or over a period of time. If I transfer the control in one single shot, that's a point in time, like a license. But if I am transferring the control over a period of time, license has been transferred, but I am doing a customization, but customization takes 18 months. So I am transferring the control over the development of the WIP or development of intangibles under progress over a period of time. So the revenue relating to customization of software will be recognized over a period of time. So at a point in time, if the transfer of control happens on a single point, if it is happening over a period of time, control is being transferred and customer starts enjoying the benefit of the development, then the recognition should be over a period of time. There are guidances available for the recognition principles relating to what is the conditions which a company has to satisfy or entity has to satisfy if the revenue has to be recognized over a period of time. It gives three conditions. Let us see that separately. If the three conditions is not satisfied, it concludes that the control is being transferred at a point in time. That means you have to wait till the control has been transferred and recognize revenue. That is where the real estate developers are get caught. That it concluded in certain cases based on the contract evaluation that the control is not transferred over a period of time, it is transferred only on handing over the flat in some cases. Why I am using the word in some cases is that there was a specific question which has been asked to the institute, especially the ITFG. ITFG is nothing but India's transition guidance group, which actually helps even when you are asking questions relating to India's transition, what type of the principles you have to apply. When they have asked, is it correct to say that all real estate developers could not account their revenue over a period of time and it should be recognized only on completion of the project? They have asked this specific question, and the institute came out with a specific guidance saying that there is no rule which says the revenue relating to real estate development should be recognized only after the control has been fully transferred. You have to see what is the terms and conditions you have agreed with your customer, and if it proves that the control is being transferred over a period of time, or any of the conditions given in paragraph 35A, 35B or 35C is actually fulfilled, then still that entity will recognize over a period of time. So that means 35A, B, C is what we have to evaluate whether it will satisfy a real estate developers. For our understanding, the transfer of control is the key, and if it is transferred at a point in time, then completed contract method. If it is being transferred over a period of time, that is during the performance of the contract, then percentage completion method. So this is the key for recognition of revenue. That is the reason why, if you are still writing your accounting policy saying that revenue is recognized when the risk and rewards of ownership has been transferred to the customer, you are making an error. So you should always look into what is the point in which the control is being transferred, and that is the way in which your accounting policy should be redefined or revisited. Correct. As I said, there is a 5-step process which the standard has introduced. Actually, the standard will be dealt with by me as a step-by-step process, step 1, step 2, step 3, and what are all the issues in the respect of those particular standards. That's the way in which we will handle it. And of course, it gives elaborate guidance. The standard is a very big standard. In fact, if you wanted to have a good sleep, take that standard and take it to the bedside, start reading the standard, you will get a good sleep. But the step 1, step 2, step 3, the way in which they have structured the entire standard, it's very interesting to see. Guidance is available for each of the steps. And it also says that in this scenario, your judgment may also require to be further evaluated. It gives where that type of challengings or judgments will be challenged by the standard. It also gives some sort of guidance on that. So let us understand what is a core principle. If you see that the first bullet or the box which I have said is actually borrowed from the standard verbatim. It says entity recognizes revenue to debit the transfer of promised goods and services to the customer in an amount that reflects the consideration to which entity expects to be entitled in exchange of those goods and services. Let us forget about the entire definition. What it says as a crux of the story is, it talks about transfer of promised goods and services. So that means sale of goods, sale of services is covered. And you are also giving a promise of when the transfer of goods or transfer of services will be done. That is the reason why it talks about promised goods and promised services. Your accounting policy should also mention like this: revenue from contract with the customers are recognized based on transfer of control of and the transfer of promised goods and services, which may be for each of the streams you define when the control is being transferred, and whether it is recognized over a period of time or at a point in time. That's your accounting policy according to Ind As 115. And second, it talks about amount expected by the entity. Interestingly, this is totally different from what we have seen in Ind As 18. Ind As 18 says revenue should be recognized by means of fair value of consideration received or receivable. It talks about even if you are entering into a contract to sell at 100 rupees, but the fair value of that particular contract is 120, your revenue top line should be 120. And what to do if you are doing only 100 as the amount received? That you have to treat it as a separate transaction. As far as the top line is concerned, fair value of the consideration received or receivable will be your top line. Whereas here, the principle says what the entity is expected to receive by means of contract with the customers. That means what is the amount you have agreed with the customer is the transaction price. And you cannot think about doing a fair value of the transaction price. Even I am giving at a discounted price, even for a related party I am selling at a discounted price, that is not the basis of making a revenue recognition in a different manner. It is only talking about amount expected by the entity is the basis for determining the transaction price. And it also comes out from our discussion that revenue is arising from ordinary activities. Let us take an example. A textile industry is having a lot of looms, and looms requires a replacement. They are changing the looms, and old rooms are sold to another company which wanted to buy that as a machinery for them. So when I recognize the profit, because it has been considered under property, plant, equipment, when I have a sale consideration arising out of it, can I take this sale consideration as my revenue or part of my turnover? As all of you will aware that when I sell a property, plant and equipment and there is a surplus arising out of it, it is not arising out of my ordinary activities. It is an incidental. It is not my ordinary activities. The purpose for which I purchase property, plant and equipment is to use it in my production process to generate cash flows. And accordingly, this is a category to be classified in respect of that as not revenue from contract with customers. It is nothing but an other income or miscellaneous income. So that is the reason why the standard says revenue is normally arising from ordinary activities of the particular entity, not by means of something else. When we have this, one challenge which we are actually having is that Schedule 3 talks about a presentation. Schedule 3 talks about revenue from operations, from sale of goods, sale of services, and then it also has other operating revenue, and then it has other income. So these are three types of income which is coming in Schedule 3. What will happen if I have some income which is happening because of my top line? For example, if I do an export of goods, I am entitled for a scrip for import, or import license is being given. We call it as an MEAS license. When I am getting the license, that license has a value to be sold. I am selling that. Whether I have to treat that as a miscellaneous income or I have to treat it as part of my revenue because it's arising out of my ordinary activities, or if I say no, this is not, you are not selling or exporting your goods for the purposes of getting MEAS license, you are actually going to realize your sale proceeds. Incidental to that is you are also entitled for a transfer which is coming as a MEAS license. Similarly, duty drawback is another thing which will be coming in. Interestingly, what the standard says is that if a revenue has been considered to be falling under this standard, there should be a contract with the customers. Do I have a contract with the government for getting that particular duty drawback or MEAS? People can argue by saying that because I am fulfilling all the conditions relating to MEAS scheme or the duty drawback scheme, there is an implied contract between me and the government, and I fulfill the conditions and I am entitled for it, so it is a contract with the customers. That could be an argument which can be put forth. Why I am using that as an argument which can be put forth is, sometimes your client will be insisting that I don't want it to show it as another income, but I want it to show as part of other operating revenue and take it as part of my revenue in the profit and loss account on the face of it. Could be possible by means of this argument. But interestingly, the standard also says if this revenue recognition is arising out of another standard, you have to go with the principles given in that particular standard. For example, when I am taking the case of MEIS or duty drawback, that is governed by another standard, Ind As 20 on government grants. So government grants, when I am receiving, it is not part of my revenue. It is something else. Normally it should go to other income. By means of an argument, this arises not because of government gives a grant for me just like that for my operations, but because I have done an operating activity, incidental to the operating activity I have this. Why I am explaining so much is, there was a specific question which came from one of the client long back, but not under this particular Ind As 115, but as per Ind As 18. They said that we wanted to take all of our other operating revenue like duty drawback, your scripts, and even scrap sales. We wanted to have all these items as part of turnover. Because if it's a turnover, then automatically it goes for income from operations. But we said, unfortunately, you could not do it because of Schedule 3 requirement. So what is the only thing which we have suggested for them, maybe as a via media, is that On the face of it, it requires only two things to be presented as per Schedule 3, which says revenue from operations, other income. Definitely other operating revenue is not part of other income. So in your note to revenue from operation, you have your classification. Revenue from operations, sale of goods, sale of services, and then you also say other operating revenue, put the total, let the total be part of your P&L. On the face of it, you can present it. But as far as the notes is concerned, it is very clearly defined by means of subtotal what is revenue from actual operations, revenue from other operating revenue. So this sometimes it's only a presentation which will have a feeling that company is having a better turnover. But strictly speaking, if we are looking into that, it is not forming part of the revenue because of two reasons. One, there is no contract with the government. Just because I fulfill the conditions, it is not considered as a contract. The second, because the contract says you should be able to enforce it by law. That means if I am completing my exports, I should enforce the government to give me the duty drawback, and I should enforce the government to give me the MES license. But in majority of the cases, you might have seen that the client doesn't want to accrue that as a revenue unless it's a listed company, because a listed company they always wanted to have the top line better. If I'm talking about a company which is very conservative, they don't want it to accrue that revenue because they believe till such time I'm actually receiving the money, there is an uncertainty over receipt of that particular money or recovery of that particular amount. And to that extent, if you see, majority of the accounting policies will normally say that when the company believes that it will meet the conditions attached to that and there is no uncertainty of collection, because that is also coming as per Ind As 115, as per Ind As 20, and you can still have that as a policy and go on. But if a company wanted to accrue that as a revenue, and my feeling is there is no contract with the customer and it is only an incidental income, that incidental income may be part of your other operating revenue. In fact, in one of the forum, there was a very huge discussion on why scrap sales is not part of my revenue, because it is also sale of goods. So why can't I take this as part of my revenue? We only asked one question. When you go for a manufacturing activity, what is your ordinary activities? To take the product or to scrap it? If I say I am putting all my raw material to make a scrap, then it's an ordinary activity. When you say I am manufacturing a product, incidentally I have a scrap which may be because of the material nature, scrapping, maybe shaving or forging or whatever you are doing, you get some additional scrap. So incidental activity or the main activity is your product, incidental is a sale of scrap, and to that extent it's only other income. That's what we have concluded, and you cannot take it as part of your ordinary activity. Taking it to other operating revenue also, there are people who are objecting that it's not my other operating revenue, because that is not arising out of my intention. It is only incidental and it should go to other income. But I support the view that it can be considered as another operating revenue. Because of your operations only, that scrap is being generated, you can still have it as another operating revenue. So this has to be bear in mind that revenue should be arising out of ordinary activities, and this revenue should not be covered by means of recognition and measurement principles given in another standard. For example, if I am talking about lease income, lease rental being received, I cannot go into this standard because there is a specific standard which is available. Ind As 116 now, which we will discuss later, and we should go into that particular standard for recognition of revenue. But suppose if I am not actually giving on lease, but I am getting a rent by giving the items on hire, because if you see Ind As 115 and Ind As 118, it actually talks about sale of goods, sale of services and other income. Other income is when the entity's assets are given for others to use it. A machinery has been let on hire. So whether that income will go to lease accounting or it will go to Ind As 115. you have to look into the terms and conditions of the contract. If you are just giving it on a lease, then accounting standard on Ind As will come into the picture, on leases will come into the picture. Otherwise, it normally goes into this particular standard. So you have to analyze the contract with the customers and what you consider as an ordinary activity. And we are considering transfer of promised goods and services. There should be a promise in the contract. And what is the consideration expected to be received by the entity and not fair value of the consideration received or receivable. Okay, this is the core principle. Let us go into the 5-step process with, yes sir.
So just one point. What is the subtle difference between expected to be entitled versus realized and realizable which we had earlier?
You are talking about expected amount expected by the entity. Let me take an example. Assuming that the goods are sold to a related party. Market price is say 100 rupees and you are selling at 95 rupees, giving a discount of 5 rupees. When we are applying the previous standard says that fair value of the consideration received or receivable should be considered as your turnover. So my actual amount received is 95, but the fair value of the consideration, that is what is expected to be received, is 100 rupees. That is what I have to take it as top line according to old standard. New standard says fair value of consideration received or receivable is not the basis. What is the amount expected by the entity by means of selling this goods has to be considered. So 95 rupees will be the turnover under this standard. In simple terms, net P&L impact will be the same. Presentation of revenue will be 100 in the previous scenario, 95 in the current scenario. Previous scenario, when 100 has been treated as revenue, 5 rupees will be treated as selling expenses or discounts allowed. So that's the way in which it has to be considered. There could be a scenario where you can talk about, because when I am using the word discount, immediately your mind will change because turnover has to be shown net of discount. Assuming that I am going to get the amount over a period of time, there is a financing component which has been involved, then that should also be taken into consideration. So accordingly, amount expected by the entity means it's what is the transaction price agreed between your customer is the basis. In simple terms, the standard makes it life simple by saying that whatever is the revenue recognition should be arising out of the contract. So what you have agreed with the customer and what the customer is expecting from you, for which customer is making the payment, that should be the basis. Forget about what other complications which you wanted to do. That's the way in which it is being structured. Okay, sir?
Excuse me.
Yes, sir.
What if there is a bad debt element?
We will come into that,
Yes.
sir. Okay.
You expect something to go bad.
Hmm.
Invoice raised within the year.
Okay. So for example, let's take this example. I think that bad debts is not getting covered in this particular presentation. That's the reason why I am taking it. So if we are taking a case where I am selling to a customer based on the contract with the customer and the transaction price agreed is say 20 lakhs for the transaction. Control is transferred. The only question which I am having is that I sold, say for example in April, and 90 days credit has been given to the customer. Before March it is not collected, and I knew that this amount will not be collected because the customer become a bankrupt. So the sale has happened in the same year, and subsequent to the sale I also understood that the customer will not be able to make the payment. So there is a credit risk for which I have to create an expected credit loss based on Ind As 109. The question is whether the turnover will be top line on a net basis, because under 20 lakhs is what is the turnover, and 20 lakhs is the provision to be made. Can I net it off and say that my turnover on the top line should be reduced by 20 lakhs? Unfortunately, the answer is in the negative. What it says is that if the uncertainty is existing at the time of making the sale, at the point of making the sale, if the uncertainty is there, you should defer recognition of the revenue. That means you could not even pass an entry. Maybe for the purposes of your GST and other applicable laws, you will consider that as sale. But for Ind As 115, if there is an uncertainty of collection at the time of transfer of control, you should defer the revenue and recognize the revenue where that uncertainty has been eliminated. Maybe it is eliminated in the next year. When you have actually collected it, you will recognize it. But if I have already made the sale, subsequent to the sales there is an uncertainty of collection comes in, it is covered as a credit risk, and that goes to Ind As 109. And to that extent I will have 20 lakhs as my turnover, and I will also have a proportionate provision to be created as per Ind As 109 for the expected credit loss. So the point at which the uncertainty exists makes me to recognize or defer the revenue. Now, in the example given by sir, it's that sales has been made in April, subsequently the client becomes bankrupt, and accordingly turnover will continue to be 20 lakhs, and the provision for expected credit loss will be debited to P&L as an expenditure 20 lakhs. Now, let's go to the 5-step process which the standard is talking about. The standard says you have to identify whether there is a contract with the customer. In fact, this question, we internally use that as a gated question. So when you say gated question, you may be using it in your normal language also. It's like a username and password. If you are authorized to use this particular software, or you are authorized to enter into that portal, you first have your credentials given. So you give the username and you give the password. If it is not matching and you don't have the access to this, it will simply say the username does not exist and you are out from that portal. You cannot enter into the portal. Similarly, the very first condition for applying Ind As 115 is like a gated question. It asks whether you have a contract with the customer. If I say I do not have a contract with the customer, the standard says please go away from this standard, find out what is the applicable standard by which you will enter this particular transaction or account for this particular transaction. Let us have an example. Let's say that's what I have talked about. When I have an entitlement for a government grant, whether I have a contract with the government, I will conclude that there is no contract, and to that extent this standard is not applicable. And I am looking for an applicable standard. It gives me Ind As 20 government grant, where it says if any amount has been received from the government and to that extent there is a concession arrangement or you have entered into that particular scheme, you are entitled for receiving that particular. You are able to hear from the last row, or otherwise I will raise my.
Yes, sir.
Yeah. So you can recognize the revenue only based on Ind As 20. That is what the first step is talking about. You should have a contract with the customer. There are a lot of challenges in this first step. We will discuss that with some case studies. And the second step says that what are all the performance obligations you have agreed in the contract with the customer, or otherwise you identify what is the promised goods and services in this particular contract with the customer. If you have said I have agreed only one promise of selling a good, then it's a one single performance obligation. If you are combining more than one promise and say that this is a consolidated price, what the standard says is that you have to identify the various performance obligation, and the related revenue should be recognized only when the performance obligation has been completed or being completed over the period of time. That is the second step, which talks about identify the performance obligation in the contract with the customer. Why that is required? Why that is required is for a simple reason that each performance obligation has to be tested for the transfer of control. As we have seen earlier in the initial slides, we should understand what is the actual requirement. We have to see that. The third is an important point. We maybe start laughing at this number in this bullet, because when I am entering into a contract, there is a price which has been agreed. But why should I determine my transaction price according to this standard? That's another interesting question which is coming in, because the standard assumes that the contracted price or the fixed price which has been agreed between the customer may not be the transaction price according to Ind As 115. There could be other items which has to be factored to determine what is the transaction price or what is the contract revenue. For example, You agreed for a discount. You agreed for a cash incentive. You agreed for some sort of recovery from the customer for some expenses incurred. The customer has agreed to give you some incentive for the level of performance or quality of work you have done. The customer has given you some sort of additional money or bonus by saying that if this has been completed within the time period, we will give you some additional money. The standard says what is fixed in the contract is not the actual transaction price. You have to factor the entire amount and consider what is the transaction price. In simple terms, the standard says that transaction price includes both fixed consideration plus the variable consideration. You will see what is variable consideration. Whatever I have explained as incentives, etc. are considered as variable consideration. Both put together is considered as a transaction price as per step 3. Why this transaction price is important? Because this transaction price has to be allocated over the performance obligation identified in step 2. In step 2, in our original example, we have promised 4 performance obligation of selling the license, giving the customization, giving them training and providing the 1-year maintenance, or the performance obligation which we have talked about in the example. We have to allocate the transaction price over these 4 different performance obligations. Once I have allocated, I have to decide what is the point at which the revenue should be recognized. So the revenue should be recognized normally. In simple principle, it says if the performance obligation has been completed. The question comes is, what is the point at which the performance obligation is considered to be completed? If I say the performance obligation is completed at a particular point of time, for example, in our case, when the license has been transferred, it is completed. The transfer of control on the license has been given to the customer. So it is completed at a point in time, so I will recognize over a point of time, and assuming that there is no other performance obligation identified in that particular contract. I am only going to get the license. No customization is required, no training is required, no support service is required. Only license is what to be taken by me. In that case, the moment the license has been downloaded from the official website, because physical copy is also not required nowadays. If you are saying, normally we click no, we agree with the terms and conditions. So automatically it comes as a checkbox with a tick. So you are only saying accept, without knowing what is there actually in the terms and conditions, because we don't have the time for that. The moment you click accept, you have entered into a valid contract with the customer. And if the customer, with the customer, and when you are giving access for the customer to download that particular software into their system, the license is granted or the control on the license has been transferred to the customer at a point in time, you recognize revenue. But in the example which we have said, not only license, the customer also wanted a customization, customer also wanted a training, customer also wanted a support service for the next 1 year. So accordingly, single price has been fixed 10 crore for meeting all the performance obligations, and accordingly whether the control transfers at a one point in time or over a period of time. Maybe the license has been transferred at a point in time, but the benefit of customization till system, assuming that the customer cannot use that software according to their requirement. So just keeping the license is not enough for them, so they need a customization. So it comes under a case of the performance obligation is being fulfilled over a period of time. So we go for a percentage completion method. The way in which we are doing the percentage completion method is almost the same like what we have adopted in AS 7, AS 9, Ind As 11, Ind As 18. So the same principle can be simply adopted. Only thing is you have to evaluate whether it meets the criteria of over a period of time. So on that basis, we will recognize the revenue at the particular point in time or over a period of time based on the transaction price identified in step 3 and on the performance obligation which has been identified in step 2. It seems to be like, yeah.
This 10 crore example you said, any collection of money determine the collection of money from customers?
Okay, you are talking about assuming that
Trading.
on signing the agreement you get 80% of that.
Yes.
Okay. Good point, sir. Maybe I will miss that, right, that you have made that point. Assuming that in the contract of 10 crore, the terms and conditions says that on signing the contract, you have to give us an advance of 2 crore, or you have to pay instead of using the word advance. The moment I use the word advance, you know that it's only an advance from customer. If I say on signing the agreement, the amount payable, the transaction price payable is say 30% of the contract value. So on 10 crore, 3 crore will be paid. Second stage says that on downloading, or where the access for downloading the license has been given, you have to pay another 30%. The question comes is, maybe on day one itself both might have been done, because I transfer the money and then I get the access for downloading it. The question comes is whether this 60% which has been received on day one should be the basis for determining my percentage of completion of the contract with the customer. Whether I have to recognize 60% of my total revenue or total contract price of 10 crore as my turnover and related expenses here. Interestingly, if you recollect your earlier knowledge on AS7 and AS9, it very clearly talks about 2 points. One, it says progressive billing, advance payments are not the criteria for determining the stage completion or percentage completion. So to that extent, percentage completion will not be disturbed by means of getting an signed or cash flow model. It says that it's nothing but a cash flow model which you agreed with the customer. It doesn't have exact relationship with the actual performance of the contract according to the obligation which you have entered into. Having said that, so that means the 60% is not the percentage of completion. You have to actually see what is the exact work completed. Maybe license has been allowed to be downloaded, that is the, assuming it is only 20% of the total contract, then 20% of the revenue will be recognized. And what is the proportionate cost of amortization of the license will be your charge to P&L. This is the answer for the question he has raised. There is a supplemental question which arises out of it. Since I am getting 60% of the total contract value in advance, whether any other thing which has to be considered when I am determining my variable consideration. Because total transaction price is your contracted fixed price plus variable consideration. One of the elements to determine variable consideration says if there is a significant financing element involved in the contract, then you have to unwind the related interest and remove it as a separate item and recognize only the balance portion as your contract revenue. Meaning what? When I am taking 30% or 60% of the money upfront, client actually gives me an advance of 60%. And if the development goes or customization goes for next 3 years, 3 years well in advance I have received this money. He has financed me for doing my working capital requirement. To that extent, it has a significant financing element, and this significant financing element has to be unwinded for the implicit interest. What it says is that if somebody is coming and transacting with me with a cash price, what is my selling price? If somebody is going to defer the payment, what is the selling price? If I am going to defer the completion of the performance obligation, because client gives well in advance, definitely I might have considered giving him a concession, and to that extent, that significant financing element, implicit interest, has to be unwinded. My selling price will be higher, and this will be considered as an interest expenditure to be recognized over the period of fulfilling that contract. This is coming as an additional requirement when advances are received from the customers, and when you have concluded that it includes a significant financing element. I have a separate slide on talking about it, but the principle is this. There are some tricky situations where interest has to be unwinded or not to be unwinded. We will discuss that. But the position is advances and the progressive billing, because in a transaction we simply make a progressive billing without even talking about what is the actual level of completion of the work. Those are not the basis for revenue recognition. If the progressive billing is as per the actual work completed, then it is part of your percentage completion work. Normally, in a real estate sector, on signing the agreement, 20%, on stage basis, they will ask for the money. But if you are looking into the proportionate actual work which you have completed, it may not be matching. So in those cases, this progressive payments or the advance payments are not the basis for percentage completion. Having said that, there is one more point which is also being mentioned. Retention money. Sometimes in a contract, the amount agreed is 100, out of which 10% has been retained by the customer. He says, after you have installed the machinery or after you have given the service or customization, we will have this retained for the next 1 year. If any deficiency in service or deficiency in the product, you have to make good. If you are not making good, we will adjust this number in our out of the retention money, and when we will release the balance amount. And after the warranty period is over, that is a 1 year period is over, we will refund this money. So whether that 10% should not be considered as a contract revenue on the total contract price, whether I have to consider only 90%. The standard says that whatever amount you are expected to receive out of that contract is considered to be part of your contract revenue. So retention money is also expected to be received only on fulfillment of that. So you should normally apply that principle. And if some client, to my mind, no client will argue like that, because majority of the client who are following Ind As wanted to have a better top line. But some client who are having a worry on whether it is contingent upon my fulfilling the conditions attached to the retention money, and if I believe that I may not be able to fulfill, or I believe that it is uncertain whether there will be any retention money refunded or not refunded, they have a feeling that there is an uncertainty existing at the point of sale. So accordingly, 90% is my contract revenue and 10% is only after I fulfillment of the conditions attached to that at the end of the period. So that is also possible. 90% can be considered as contract revenue accounted on percentage completion, 10% at the end of the period when the retention money is, the conditions for retention money have been fulfilled. Still, it is possible in accordance with reading of the standard. And if you still wanted to have some sort of guidance, take the guidance or technical guidance issued by the Institute on Income Computation and Disclosure Standard, ICDS. ICDS on Revenue Standard and ICDS on Construction Standard specifically talks about that revenue includes, or contract revenue includes the retention money. Specifically they have included that because there are various case laws which was saying retention money is not revenue unless and until the conditions attached to that is being fulfilled. So that means it is postponed. Now ICDS has modified the position by saying that it should be part of the revenue. Because of that, even if you are trying to do something differently, under ICDS you have to add that money back. But the technical guide says what ICDS can do is only talk about how income has to be computed and recognized or disclosed. It should not be even talking about recognition. Income should be computed. That's what the objective of ICDS, but it cannot define what is income. What is income is governed by the law, the act, and also based on the judicial judgment. A standard cannot define what is the income. So to that extent, Institute technical guidance says that retention money can be postponed and recognized after the conditions relating to that can be applied. So if somebody wanted to use that principle by saying that 90% is my contract revenue, 10% is uncertain, you can still postpone and recognize it according to Ind As 115 also. But only thing is, please make a proper disclosure about what is your accounting policy. Now, the step 1, yes sir.
Losses on account of quality issues which is subsequently debited.
Okay. Suppose if I have a rejection, whether I have to adjust the rejections in the contract revenue. That means I have to reduce from my selling price. But if you remember that normal principles of revenue itself, it says sales returns or rejections or quality rejections or adjustment to your revenue only. It is not a separate expenditure. Interestingly, what happens is the standard talks about when you are selling to the customer and there is a possibility that the customer will return the goods, and it is your habit or it is your customary practice that you accept that returns, the sales returns. In put it in say simple way, sales returns are accepted as part of the contract. There were, if you remember that some 6-7 years back, Institute came out with an expert advisory committee opinion where they said that every company should estimate or every entity should estimate what is the expected sales return, and that sales return should be netted off against revenue. And they have also given another option. If you don't want it to net it off against the revenue, what is the expected margin on that particular sales return should be treated as an expenditure in the P&L account on the concept of prudence. But majority of the companies have said that the expert advisory committee opinion is only a guidance, but the standard is not prescribing anything. So we will account for the sales returns only in the year in which actually the return happens. That's what we are adopting so far, even though there is a guidance which is being given separately. The moment you come to Ind As 115, you are expected to estimate the probable sales returns and adjust on the top line. It is a mandatory requirement to do it. Whenever you have a sale process, the condition says sale, but there is a right to return the goods. So, a right to return the goods, I cannot wait till such time the customer returns the good and recognize revenue. For example, I am giving an option to return the goods within 6 months from the date of dispatch. I cannot wait for 6 months and then take the revenue into my books of accounts. What I am supposed to do is that, like warranty provision which we are making based on the previous experience of 5 years or 3 years or whatever we are trying to do, what is the expected sales return based on the past trend, and make a provision for that and adjust against the revenue. This is one of the requirement in Ind As 115 compared to what we are practicing earlier. This has to be netted off against the revenue. I think that I have answered your question.
Excuse me, I have one doubt.
Yes, sir.
In case of real estate contracts,
Yes.
there are new things which are coming like 3 EMIs, interest is borne by the developers.
Yes.
And second thing is that also 5 years I am giving maintenance.
Yes.
That is a part of the
Yes.
there also we have to estimate and
Yes, sir.
remove up from the revenue.
Yes. So real estate sector is now facing the slowdown. No, accordingly they are giving a lot of concessions to the customers. One example what sir is mentioning is that I will give 5 years free maintenance. So that means that there is a promised services which you are going to give for 5 years. What is the normal selling price of that 5-year contract? Whatever you are buying should be split between what is the transaction price for sale of flat and what is for 5-year maintenance. Sale of flat will be recognized the moment control has been transferred, but the 5-year maintenance has to be recognized over the 5 year as an income. That is where the step 5 will make the deferment of income. So when I am saying that, I will also, another possibility what the example has been given is that you go with a loan and give me the money, and whatever interest which you are incurring, I will either pay out of my pocket or I will bear that cost, or maybe we will share the cost. So in that case, what is my revenue? It is an interest expenditure, and to that extent it is not going to adjust my revenue. It is going to be recognized as an interest or finance cost over the period of time where that actual cost is incurred. It is not adjustment of my revenue. There is another case which is normally coming in. You might have seen that pay only 20% of the flat cost, 80% only on handing over. But I am using my own resources to develop that entire flat ready for the selling. So this 20/80 scheme will have necessarily to be evaluated for significant financing component, because I am advancing to my customer to purchase my flat, my development. So to that extent, I'm incurring cost on behalf of him, but he is not paying anything out of it. So there is a financing element. So the total consideration has to be split between consideration for the flat and the implicit interest income. The interest income has to be recognized over the period for which I have agreed to give him the repayment. So that's the way in which each item has to be evaluated for what is a contract, what is a promise, and what is a promise will go into which step, and based on that whether it will be adjustment of the transaction price or it will be considered under a different accounting standard. So based on which step 5 will come into the picture. Now, in the first case, it is actually talking about a lot of conditions to be fulfilled. Maybe I can simplify by saying that all the conditions to be satisfied, if the conditions have been satisfied according to the assessment, there is no need for every year I have to reassess the conditions. I have to only see if there is a material change in the condition, whether the revenue recognition has to be revisited. Otherwise, I can simply follow the existing principle. If you see all these conditions, another simple understanding of this is, it is trying to say whether there is a contract, whether it is having a commercial sense and it is enforceable by law. And it gives a right for the seller to receive the money for the work he has completed along with the profit margin. If the contract says at any point of time the contract can be terminated by either party, and what the seller will be eligible only to reimbursement of cost, the standard says it's not a contract. Because when I am entering into a revenue contract, I should be having a profit margin also. The customer is going to give me both cost plus the agreed margin, then it will be revenue. Otherwise there is no contract. And the gated question which I am saying, if this condition is not satisfied, you cannot enter into this standard at all. You have to wait for the condition being fulfilled or find out a solution in another standard. To understand this particular question, I will make a simple example. Whether there should be a written contract. Because contract normally we say that there should be it will be written. Whether there should be a formal written contract to pass step 1. It may be a simple understanding of our knowledge, or maybe a simple understanding of how we have practiced over a period of time. Nothing to worry about this standard, because the standard says the conditions should have a commercial substance, it is enforceable by law, and the party is eligible for getting his buddy along with the profit margin agreed. So if you apply this principle, whether a written contract is required or not required.
Non-written contracts are enforceable by law, so it is not required.
That is a simple common sense. I always try to say that common sense is codified, that is what accounting stands. The standard says the same thing. As long as the oral contract or business practices which is enforceable in law. For example, a customer makes a call or phone and says, deliver me 10,000 pieces on Wednesday. The supplier makes the supply, and it goes along with the invoice come delivery challan. It is accepted by the customer and goods has been received, and acknowledgement has also been received. So I have made an offer, it has accepted, and the contract has been fulfilled, even though there is no written contract. That makes a contract which is enforceable by law. The terms and conditions are completed of the transaction. So it says that there is no need to look for a written contract, even a oral contract, or even customary practices, but the condition is it should be enforceable by law. That's what it is actually looking for. We will go to the step 2, identifying performance obligation. Here what it says is that I have done some work. Whether that work is creating some benefit on its own independently or along with some other activity, so that the customer will have some benefit out of what I have performed. Let us take this example. Customer gives me a contract for construction of his factory shed. I have dumped the sand. I have dumped the cement. Whether the sand and cement can be considered as my part of my performance obligation being completed. The first condition says whether the customer benefit from the goods and services either on its own or together with other resources that are readily available, for the customer. So if we take the case, just by taking sand and just by taking cement, whether he will be having a factory shed, whether it will get completed is a question mark. Argument can be put forth if the contractor has not started this and it is supplied at the customer site, customer can have the control over this supply of sand and cement and use another contractor to complete this entire work. So I can still argue that it's a possibility of saying customer has a separate use. Whether this, it says it should be a cumulative condition. Whatever the entity promised to transfer is separately identifiable from other promises in the contract. If you take the second one, what I have agreed is to construct the factory shed, not just supplying sand. It's incidental to my contract. So it's integrated for the performance which I have done to construct your factory site. And the second condition is not fulfilled. Even if I argue that sand can be used for constructing it, but the second condition is not fulfilled, only if both the conditions are fulfilled, you are considering that there is separate performance obligation. Otherwise, they are considered as a combined obligation or a single integrated obligation. What is the meaning of two performance obligation or separate performance obligation? Revenue will be recognized or the transaction price will be allocated to each performance obligation. If I am saying it is an integrated or single performance obligation, the entire thing is relating to one activity. That's what the understanding of step 2. We will break for tea and then we will reassemble. According to this watch, it's 11:30, 11:45 we will reassemble. சொல்லுங்க ஜோ. சரி 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 அதுதான் எனக்கு நான் அந்த தேர்ட் ஒன்று இப்போ ஒரு மெயில் வந்திருக்கு, அதை நான் கவனிக்கல நான். ஓகே, நீங்கள் ரிவ்யூ பண்ணிவிட்டு அதுக்கப்புறம் சொல்லுங்கள். தென் ஐ வில் ஹேவ் ஏ லுக் மேபி இன் தி போஸ்ட் லஞ்ச் அந்த ஐ வில் ஹேவ் ஏ லுக் அண்ட் தென் வி வில் ட்ரை டு சென்ட் தட் ஆல்சோ. ஓகே, ஜிஎஃப்எஸ்எல் என்ன ஆகுது? சரி, ரைட், ஓகே. ரெண்டு ஸ்டாண்டர்ட் 115 and 116 மத்தியானம். ஓகே ஓகே. Third step, determining transaction price. I have explained in detail that transaction price includes both fixed consideration as well as variable consideration. As we have discussed, variable consideration may be discounts, may be credits, may be incentives or performance bonus, etc. And the step requires you to identify whether the contract conditions gives rise for some sort of variable consideration? If so, you have to add that to determine what is the contract revenue, and that transaction price is actually going to be allocated to the other category. So two methods are mentioned in this particular variable consideration, how it has to be done. One method says what is the probability weighted amounts which you will collect over a period of time based on whatever you are fulfilling, or the expected value of the variable consideration which you will collect is what they are saying as a method. And another method is what is the single largest amount or most likely amount which you will collect when you are fulfilling the conditions relating to variable consideration. So the question is whether I have to use always the expected value or I have to use the most likely amount. Clearly it goes with the most appropriate method, depends upon the terms of the contract. For example, if I am saying I will pay you if this contract has been completed within 18 months, this much of amount. If it is completed in 24 months within this is the incentive which I will given. What we will apply, whether it is the expected value method I will apply or most likely amount I will apply. I will only try to find out most likely amount, because whether it is completed within 18 months or 24 months based on which I am entitled for this, or whether I am not at all going to complete within the 24 months, 0 is the value. So the most appropriate method will come on the basis of what exactly we are talking about as the terms and conditions of entitlement. Another example which we can talk about is that I have supplied you some goods or some machinery, and the machinery says that using the machinery you will able to achieve some sort of manufacturing of the goods, number of units which you can manufacture and you can sell. If I am saying that if you are able to manufacture 1 lakh units, you are entitled for 5%, and between 1 lakh to 5 lakh units you are entitled for additional 2%, 5 lakh to 10 lakh units you are entitled for additional 1%. So in that case, I cannot say what is the most likely amount, because it could be in the various weighted buckets. 1 to 3 I get 5%, 3 to 5 I get 2%. So I have to estimate what is there in first bucket, what is there in second bucket, what is there in the third bucket, and the cumulative balance is what we will consider as a variable consideration. So that is the reason why the standard says that you don't stick on to a particular model as a rule. It is based on what is the entitlement to receive, that should be the basis for determining that. Interestingly, it also says that you should apply only one method consistently throughout the contract. For example, I have fixed a variable consideration based on most likely amount. No condition has been changed with respect to the contract. In the next year, I wanted to reassess by saying that expected value method will be more suitable for me. It prohibits such type of application. It says you have to stick on to the same method unless the contract condition itself has been changed. That's the guidance for taking into consideration the variable consideration. And of course, whatever we are estimating or whatever we are assessing as variable consideration is purely an estimate, and accordingly it has to be reassessed. For example, first year I have estimated that the customer will be able to manufacture 5 lakh units. According to my assessment, up to 3 lakh units I am entitled for 5% additional, and for 5 lakh units I am entitled for another 2%. So between 3 lakh 1 unit to 5 lakh unit, I will estimate another 2%. That is my estimation based on what customer can do. Assuming that at the reporting period, the customer has not actually manufactured more than 3 lakh units or within that 3 lakh units bucket. Whatever estimation which I have originally done for the purpose of determining my contract revenue has to be reassessed, because it's an estimation. Because it's an estimation, whatever change which is happening is only a change on a prospective basis, not on a retrospective basis. So that means when you make the change, you are readjusting the estimate and the effect will be given on a prospective basis and not going and changing whatever you have recognized already. So for example, 2 years is over, then you are finding out a change in your anticipation of variable because of the new development. I cannot go and change the numbers which I have recognized earlier. It should be recognized as an adjustment in the subsequent period. So maybe a reversal of total income happens, it will be debited in the current year P&L because it's a change in estimate, not as an adjustment as a change in accounting policy. So this is on variable consideration. So various examples which I have taken on variable consideration. Contract cost is very simple. What is the contract which has, again, we will incur to complete the contract? What is the anticipated contract to complete and execute the contract? And the cost which I am expected to be recovered from the customer. Normally that is the contract cost. And if you see the list of items which has to be included, there is no difference between our existing practice. Whenever we are talking about a direct labor to complete the contract will be part of the contract cost. Why this is important? Normally the percentage completion or over a period of time when we are recognizing revenue, we will use a method called cost incurred to the estimated total contract cost to complete the contract. So if I am including administrative expenses also as part of the contract, the percentage of revenue recognition may be wrong. That's the reason why it says contract revenue is a transaction price, contract cost is only these items which has to be included as a contract cost. If I am applying cost to total cost applied, what is the cost incurred up to the stage of completion vis-a-vis what is the total contract cost expected to be completed into what is the transaction price is my revenue to be recognized at the particular period. So that is exactly what they are talking about as contract cost. There is no difference. And what is to be excluded is also similar to this. General administrative expenses are not included, abnormal wastage is not included, cost relating to past performance, that is before the contract has been achieved. If you have incurred certain expenses and say that this is relating to this contract, so whether I can charge it to that contract, it says that cost, unless it is recoverable in the contract, it cannot be part of the contract cost. So that has to be treated as a sunk cost.
Can you go to previous slide? What is specifically chargeable cost? Any example?
So for in some cases, maybe we can take a simple example where there is an architect who is also taking a contract for advising the client when the construction is happening. So he is also part of that, but the architect will be reimbursed his out-of-pocket expenses. That is the contract defines, this is your fee and whatever actual expenses incurred will also be reimbursed. That is also considered as specifically chargeable cost to that. Or sometimes I have taken a contract for construction of this and I will say that for testing the stability of the soil I will engage an external consultant. Whatever fees which I am paying and actuals you have to pay. So that is specifically chargeable cost. So significant financing element is what we have already discussed. Only thing is the guidance which says is that two things the guidance is talking about. Always consider the transaction price with the selling price, normal selling price. That means if you are giving a 90 days credit to all the customers, what is the selling price you determine and what is the transaction price which you have agreed with the present customer. That will show whether there is a significant financing element comes into the consideration. That could be one example. And the period between the payment received and the delivery of the goods which is happening will also show that there is a significant financing element. That's what I have said, 20 to 80 in a real estate development, where 20% is paid, but the actual delivery of the goods is happening over the 3 years of development. And similarly, when I have received the advance from the customer, but I am delivering over a period of time, there is a possibility of the delay between the payment and the delivery. There is a gap between that. And what is the market interest rate? Assuming that if I have to go and take that advance in the market, somebody will charge me 10%, but I am getting 0% from the customer. Then I have to consider that as significant financing element. Suppose if the customer says, okay, I don't mind giving you the entire amount as an advance, but we will charge you 7% interest. Whether that 7% is equivalent to the prevailing market rate. If I say yes, then no adjustment on revenue will be there. Because I am taking this almost like a loan, and for which I am paying him 7% interest, which is separate transaction. Accordingly, my transaction price need not require to be adjusted for significant financing element. The second guidance which comes in, first guidance is to identify whether there is a significant financing element. The second guidance which is coming in, assuming that you identified that there is a significant financing element, what is the rate by which you have to split the implicit interest? That comes as the second guidance. Interestingly, it says that what is the rate at which the customer will borrow in the open market? I don't know. You have to make your own assessment. For the similar tenure of a loan, what would be the rate which the customer will pay maybe to a bank? You can take that as an assumption. In practical sense, we normally consider 10%. Normally consider 10%. There are two reasons. One, 10% is a round amount, so calculation is easy. It's a practical way of looking into that. The second thing is we have also seen, if you are talking about a tenure where the interest rate is, say for example, 6.65%, where the transaction is entered into, this is a risk-free return is 6.65%. When I have taken a risk of giving a credit to a customer, there is a situation of risk premium which I have to consider. Normally the risk premium is ranging between 2 to 3%. Even assuming that it's 3%, 9.65%, I make it as 10%. So one of the client very strongly argued, sir, you are assuming 10% discount rate. But actual rate which we have taken from our bank is 9.5%, including risk premium. Because they said, we have identified that 9.5% we can take the loan. So do the discounting at 9.5%, where we were consultant for an Ind As transition. I was trying to tell them, sir, forget about that, it will not have any impact on the numbers, but they have insisted because the auditor was insisting that. And don't ask me who is the auditor. The auditor was insisting because he is not doing the conversion work assignment, he has lost the assignment and we got the assignment, and accordingly put the pressure on me. He has said that 10% they have assumed it's not supported, 9.5% is what you have taken from the bank, so apply 9.5%. And I said, no problem, we will do that. We have prepared a statement based on 10% I am already there, then 9.5% when we have applied, and we have also given a columnar details reducing up to 3% from 10%. So that means we have gone up to 7%, where they were actually asking us to go for 9.5%. We have done a comparative assessment up to 7% and shown that the amount of implicit interest is not material to the financial statement, and accordingly Ind As 109 says you need not do anything, and even 115 is also saying that you need not do anything because the standards are applied on the concept of materiality. And we have said, sir, you can now decide whether you wanted to pass an entry for reversing 2,500 rupees for each of the quarter, pass an entry for that, and then readjust that for every quarter and account for it. Passing an entry for 2,500 as a journal and maintaining that in the books of accounts will be more costlier than 2,500 rupees. You decide. But the actual fact is the auditor has insisted to pass a reversal of 2,500 rupees and the client is doing. We are not bothered. We are simply giving the revised working. So, but keep it in our mind, whenever we are talking about that, this concept is not simply saying financing element. It says significant financing element. Double underline the word significant financing element. If it is not material, auditor is not going to certify that it's true and correct. He is only going to say fairly presented. It is not containing any material misstatement. So to that extent, I still believe that what is the principle applicable in 109, where discounting for time value of money has been insisted, where the standard very clearly says if it is not material, there is no need. Same principle will also applied here, because the concept says very clearly only if there is a significant financing element you are supposed to identify what is the implicit interest. So this is the guidance additionally which I wanted to say. And the third guidance which is interesting is that if the period between the performance of the contract and the amount received is less than 12 months, they say that ignore. There is a practical expedient they have given as an exemption, because they believe that anything whatever you are passing as an entry in the initial stage and accounting at the end of the period will remain the same. People may argue, sir, the contract is entered in March, 12 months is getting completed only in the next period, so there is an impact on two accounting period. but the standard gives a practical expedient by saying if the performance and the payment are less than 12 months or 12 months or less, that's the way in which it is using. So contract with 12 months, you can simply ignore the impact of significant financing element as well. Even if it is 2080 and the entire work will be done within 1 year, you can still go for that particular aspect. This is known to us without even any explanation is required. It may be specifically mentioned that I will charge interest, that's the explicit. Where it says that we will give and we will adjust only at the end of the period, then it will be considered as part of your implicit financing element included there. So what I have seen is that wherever there is an advance payment received, like what you are given as an example, even if it is received during the normal business terms, should be evaluated whether it results in a significant financing element. Similarly, where you are giving a deferred payment for your customer should also be evaluated whether it's a significant financing element. When you are using significant financing element, whether it has a material impact on the financial statement, you consider. I have seen a case where in majority of the engineering contract, mobilization advance is being taken. So mobilization advance will be 30% of the total contract value paid on the date of signing, and then running bills will be done based on the actual work performed. Two types of contracts, terms and conditions we have evaluated. One case, they have entered into an agreement with the customer saying that 30% is the mobilization advance. It will be adjusted over the running bills, which will be done in the next 2 years, over the running bills. We have concluded that it is arising in the normal business term because I wanted to protect me against a credit risk and there is no significant financing element. And we have worked out the number also, it is not material, but we have concluded we need not even test for significant financing element because any advances received from the customers is not a financial asset as per 109. And on that basis, when I have received an advance from the customer, there is no financing which has been done because the terms and conditions says it will be adjusted for each of the supplies on a pre-agreed terms. So that shows only a protection against the credit risk. So we have concluded that we will not do anything on significant financing element. On the other case, they have said I will take 30% of the advances, but this 30% of the advances will be adjusted only in the last and final bill. Definitely you are giving a finance for executing the contract. So why I am explaining both these possibilities is that it is not a hard and fast rule and say the moment I take an advance, it's a significant financing element. You have to evaluate along with the terms and conditions and then identify whether anything is required to be adjusted in your transaction price. The fourth step requires you to allocate the transaction price. Interestingly, the allocation of the transaction price has to be done based on individual or standalone selling price. That means if we have, in our example, we talked about license fees, customization, training, and then 1 year maintenance. So if I have individual standalone selling price for each of the items, on that basis the entire 10 crore which we have agreed with the customer has to be allocated for each of the performance obligation. The reason is, once I have allocated the transaction price for the performance obligation, if it is completed, I will recognize that portion of the transaction price as my revenue. So interestingly, the standard is talking about standalone selling price should be the basis for allocation between the obligation. So how I will determine the standalone selling price? Best evidence is observable market price. What is the price at which I normally bill to the customers? And what is the normal price for this particular product in the market? That will be the basis for standalone best evidence. If it is not available, I have to estimate the price. How I will estimate the price? I normally try to make an adjusted number. Identical item will be taken and then make an adjustment, like what we do for fair valuation. Level 1 is your observable price, level 2 and level 3 is your adjusted price. But if I am saying I could not consider a market price, I can even go for another option of estimating the profit margin. I have incurred for the first phase, say 3 crore of cost, and what is the expected profit margin for that particular performance obligation, assuming that I will take 40% margin in selling the license, customization will have only 5% margin. I can apply 40% on the amount incurred and take that as a revenue. That is another option which is available if I am not able to find out the individual standalone selling price. If none of them are available, it says go for a residual approach, meaning what is already delivered, forget about it. What is the undelivered portion, what is the fair value or what is the selling price of that particular undelivered portion, retain that as a deferred income, balance you recognize it. But that is a last resort. At the same time, the standard specifically says you should not apply fair value measurement as the basis for allocation. That's what I have said. The difference in definition of revenue as per Ind As 18 and Ind As 115 is that it is talking about the amount expected to be received by the entity in 115, fair value of consideration received or receivable in respect of Ind As 18. So now it very clearly, very clear for us that we should not use fair value to allocate the revenue. Whereas Ind As 18, if you say, and if you are saying there is a multiple elements of the contract, the allocation will be based on the fair value of the consideration for each of the elements. That's completely prohibited as per Ind As 115 in step 4. And then coming to the final step of recognizing revenue over a period of time or at a point in time. So over a period of time is equivalent to percentage completion, at a point in time is a completed contract method. If you are manufacturing, to put it in simple terms, if you are manufacturing or selling any goods which are a standard product, interchangeable product among the customers. So that means it's a standard product, so normally it will come at a point in time. For example, an automotive industry is manufacturing gears, and the gears are a standard product. 1 lakh pieces I am supplying, but there is a master service agreement which says that you have to supply 5 lakh pieces over a period of 2 years. Whether I have to consider as a percentage completion for 2 years period? No, because it's a standard product and the risk and rewards, the control on the goods is transferred at the moment I sell that individual product, because it's interchangeable, it's a standard product. But if I am constructing an asset or developing an asset based on a specification agreed with the customer and it is not interchangeable, the another person cannot go into that. Normally it goes into over a period of time. This is for our easy understanding. If you apply this principle, normally whatever is the assessment you have done earlier as per your existing standard holds good for this also. Nothing to worry about it. But only problem which starts under this standard is twofold. One, for the real estate developer because of the industry issue, guidance note is withdrawn. Second is, it is giving a guidance saying that these 3 cases has to be assessed where you can recognize revenue over a period of time. In all other cases, it should be at a point in time. Control is expected to be transferred at a point in time. So they have come out with some sort of guidance saying that at a point in time has to be considered as a residual category, whereas over a period of time should be based on 3 different scenarios. If it is not falls under the different scenarios, it should be at a point in time. So this makes a little bit of additional assessment to be applied by companies when they apply the percentage completion. What they have talked about is, one scenario they have said, customer simultaneously receives and consumes a benefit when the entity performs. A simple example which we can talk about is recurring services, annual maintenance contract. Where I am doing the service, 3 years contract has been entered into, for which I have received the money in advance. But whether the contract revenue is to be recognized at a point in time or over a period of time. Because when I am servicing the customer, he gets the benefit and he enjoys the benefit throughout the contract period. And accordingly, this will fall under over a period of time. Routine contracts, recurring services, etc. When the customer controls the asset when it is being under development, or when the entity is performing, the asset is under the control of the customer, not with the control of the supplier. An example could be asset is built at the customer's site. When I am constructing a factory or I am setting up a thermal plant, I am doing a power plant, I am doing a solar installation, I am doing a wind energy, I am doing a turnkey contract, all are performed at customer's site, and in case if the customer is not comfortable, he can kick me out and take somebody else to fulfill the contract. So the customer has the control over this, and in that case the over a period of time can be applied. The third is entity's performance does not create an asset for which the entity has an alternative use. That means I have constructed something, I cannot make it and sell it to somebody else. That's what I have said. Specification is identified and given by the customer, I have developed it and I don't have an alternative use. And whatever I have entitled for this, when assuming that 60% of the work has been completed, is that the customer has to pay the consideration agreed for the performance I have done up to that particular stage. When I am saying I am entitled for the price, means price is not cost. Cost plus the profit margin agreed should be given to me. If that is the case, an example could be asset built to order. So customer has given the specification, I am building the asset on behalf of the customer in my site, but I don't have a separate use for it. If a customer has rejected it, I cannot sell it to somebody else. But if the customer cancels the order, he has to pay me for the performance which I have done, including my profit margin. Then it will come under over a period of time. Now let us put our real estate development into this bucket. Whether customer simultaneously receives and consumes the benefits? No. Because even for inspection I have to get the permission from the builder, then only I will go for the inspection of the construction. Customer controls the asset as it develops? No way. When I went and I was trying to inspect the flat which has been booked by me, they have said very clearly, sir, unless the engineer allows you to go and see, you can see, and you have to come back. You cannot ask any question, including when I have asked the question about, sir, you have agreed for development of a clubhouse, but I have not even saw the foundation of the clubhouse, but you are asking me to take possession of the flat. And I asked the question, they are saying that, sorry sir, this is the way in which our company operates. So whether I have a control over the asset? No, during the course of development. So that will not get into this. And the third is, whether I do not have an alternative use for the property. In majority of the real estate development, if the contract is cancelled, I can have the right to allot it to some other person, and because I am allotting to some other person, it's an alternative use, but I am getting the contracted amount. From the contract, existing contract, what I am getting is nothing but a penalty for the customer who has cancelled the particular order or terminated the particular order. So because of these three situations, majority of the people believe that, and with the withdrawal of the guidance note on real estate development cannot be based on over a period of contract. It should be based on a particular point in time, that is when the control over the property has been handed over to the customer. Having said that, I just want you to remember, Institute has said that there is no rule saying that all the real estate development only over a period of time. You have to evaluate the terms and conditions. On this basis, if any of these three conditions is suitable or possible and it's fulfilled, the entity can still go for over a period of time. And some entities are making this assessment and continuing to recognize revenue on over a period of time. Some entities have concluded that it is not possible for them to meet any of these conditions and started reversing the revenue already recognized and waiting for the period to be completed. That is what the assessment which we have to consider. So if these three conditions are not satisfied, only completed contract method has to be applied for. Transitional provision which actually says that whatever is the contract which is not completed, and they are not meeting the recognition criteria of revenue according to this standard, the revenue already recognized should be reversed with an adjustment to the retained earnings, and you have to again do the accounting on the period where the contract has been actually completed. For example, a real estate developer has recognized 60%, but he could not meet any of the conditions of 35A, B or C, then he will reverse the revenue. But when he is handing it over to the customer, he will again recognize the revenue on that. Could be
Sir, if you have distributed dividends and other things based on the old.
all are a questionable point. But only thing is, I am having only a hindsight now, but I don't know, because my accounting principle at the time to determine my allocable surplus or distributable profits is based on that accounting standard. So you cannot penalize the company for having done that distribution of dividend. Only now you are changing it. I never anticipate that you are going to change this principle in total. But having said that, there could be other issues which may come. For example, if a remuneration to a director has been based on the effective capital, and the net worth comes down, to that extent it may be an issue. You have taken a permission for borrowing powers of the directors, but the net worth comes down because of this. That could be a possible scenario.
Tax.
Tax will not have any impact, that's what I have understood, sir, because ICDS still talks about percentage completion. And it also talks about that same 25%, guidance note, whatever it says. So whatever you reverse is only for the purposes of your presentation as per the books of accounts and for filing with the register of companies or for with the stock exchanges. For income tax purposes, ICDS will recompute the same number. Whatever you are doing will be nullified and you again go back to the old method. So I have found that it will not have any impact on taxation. And for MAT purposes, whether it will have an impact is what is the point which we have to debate. Because whether the book profit has to be considered, and we have concluded, because that came as a question mark, because people have said that when I am reversing and again recognizing that revenue, in that year I don't have the current tax, but I have only a minimum alternate tax to be payable, whether I have to take this income also for the purposes of MAT, because there is no specific exclusion under computation under book profit as per 115 JB. But what we have seen is that there is one clause which says that if this amount is not allowed or something like that, it uses the word, in simple terms, it allows you to get the benefit of not double taxation. That means since I have already offered both for MAT as well as current tax, when it is again credited, we need not consider for MAT. But having said that, assessing officer will not understand this logic. It will go up to the tribunal level or sometimes even to higher levels, then only you will get the benefit. But we are having a very strong debate and it is concluded that, we have concluded, sorry, it's our view, in our firm we have concluded that it will, if MAT has been levied, we have a tenable case to get it reversed because it is already tax suffered. And one of the legal opinion which we have taken from an income tax expert who is a lawyer appearing up to the High Court, he has also given a similar view on this particular situation. He says in 115 JB itself, one particular clause allows you to do that, make use of that, and you can go it. And he also says that we have to get it allowed only in the tribunal or at the High Court level. Some of the major disclosures are qualitative and quantitative. Expects a lot of disaggregated level disclosure. What is the contract where there is remaining performance obligation? You have to explain that also. What is the timing of revenue which you are expecting for in respect of the incomplete contract or contracts under progress? You have to give some sort of explanation. And some of the items has to be classified as contract asset and contract liabilities instead of showing just as trade receivable or trade payable. So you have to identify whether that comes as part of the contract asset and contract revenue, and to that extent it should be shown as a separate line item in the balance sheet. These are all on 115. So let me just go to this standard. Before that, if there are any questions, I will take on 115.
LD.
Sorry, sir?
LD, liquidated damages.
Liquidated damages. liquidated damages, assuming that I will pay the liquidated damages because I have not executed the contract, whether it is part of my transaction price because of a variable consideration. Normally in engineering industries, this liquidated damages will be there whenever you are entering into a contract for completion, and if you are not completing, liquidated damages is there. And liquidated damages sometimes becomes a discretionary, even though as per contract liquidated damages are there, but in practical liquidated damages are not levied because of your business practice or something like that. So accordingly, if you wanted to identify what is the variable consideration arising out of that, variable consideration need not necessarily increasing your contract revenue, it may be decreasing your contract revenue also. You have to see what is the terms with your contract with your customer and what was your past practice. If you believe that definitely I have exceeded liquidated damages will reduce my income, that will also be a variable consideration. So you have to evaluate that. But majority of the cases I have seen, contract will say that if you are not making the payment within the particular date, a penal interest of 2% will be levied. And people also raise a debit note for that, but still they are not collecting it. If the customer comes and say, sir, I will pay the entire principal, don't ask me the interest, we are agreeing with that and we do the reversal on that. Maybe it is a pressure tactics to ensure that the collection is being done. So that is the reason why, see the business practice and what is done in the past, whether that forms or qualifies as a variable consideration. Then you include it as part of the contract revenue or reduce it from the contract revenue. 116 is another standard which has an implication for the current year because it is effective from 1st April 2019. So listed companies might have already reported for the past 2 quarters, and third quarter comes for December quarter, we have time. And for companies who are unlisted, there is no requirement for doing what we call quarterly results. So year end we have to definitely consider this particular standard. Again, the standard completely changes the way in which we are doing lease accounting, especially operating leases. I should say that if I am talking about a case of a lessor, absolutely, I should use the word absolutely because I have seen that no change is happening. Maybe I can say that in respect of a lessor, this standard is not having any major implication. So whatever you are doing previously will continue to be done, and to that extent it doesn't have a major implications on your lessor accounting. If I am a lessee, I have taken something on lease. Previously what I used to do is that I tried to split that into 2 categories, finance lease or operating lease. But the significant risk and rewards of ownership has been passed on to me. Even though I am paying monthly lease rent, I capitalize that asset and create a liability. Whatever payment which I am making is apportioned between principal payment and interest payment. Interest is charged to P&L, and my asset being capitalized, I depreciate that asset. This is what finance lease in the case of a lessee. If it is an operating lease, what we normally do is simple. Because we don't take the ownership and the risk and rewards of ownership is still with the lessor, I contribute only the usage charges for the asset. That expenditure which I pay is an expenditure to be charged to my P&L. So I simply charge it to my P&L account. For example, if I have taken a land and buildings on rent for my office purposes or maybe for factory purposes, the rent I pay doesn't gives me the right of ownership. It is only usage right. So usage right, I will simply charge it to my P&L account, whatever rent which I am paying. The standard Ind As 116 says, if you are having a right to use the asset, usage right, they are changing it in a different terminology. If you are having a right to use an asset for a particular period of time by means of a contract, which is a non-cancellable contract, you are not having the right on the asset, but you have the right of use of the asset. That right of use asset is considered as an asset in your balance sheet. So when I am having right of use asset in my balance sheet, the corresponding thing is I create a lease liability because I am supposed to pay this money. So when I recognize an asset which is right of use asset, equivalent amount comes as a lease liability. Every month I pay rent. Since I don't have a charge to P&L account, I have a lease liability. The rent which I paid should be allocated towards payment of principal and interest on the outstanding lease liability using effective interest rate method. So for example, if I concluded that, I am just taking a simple example, but it's a complex calculation. Assuming that I entered into a contract for taking a premises on rent for 5 years at the monthly rent of say 1 lakh rupees. And second year it is under a 10% increase, third year another 10%. Year on year there is a 10% increase. But for our calculation we will simply ignore that 5 years standard rent of 1 lakh rupees per month. Easy to calculation, that's the reason why I am putting it. If I take that 1 lakh as the payment, I am supposed to find out what is the net present value of the total payment which I will make over 5-year period. I will make a payment of 60 lakhs, right? 12 lakhs per year into 5 years I will make 60 lakhs. But I am not making the payment in the first year itself. I am making over a period of time. So naturally, the time value of money which I am making as a payment in the 5th year is not equivalent to what I am making as a payment in the first year. So it requires you to find out what is the net present value of the money which you have paid for each of the years, and that is considered as right of use asset, and you have to capitalize that in your balance sheet. Equivalent to that is your lease liability. When I am making the payment of 12 lakhs in the particular year, assuming that it's not monthly, it's a yearly for our again easy calculation. When I am making 12 lakhs as a payment at the end of the year, the lease liability, assuming that 60 lakhs has been discounted for time value of money or net present value, it comes to say 50 lakhs. 50 lakhs is the loan which has been given, because when I am saying it's a lease liability, it's like a loan somebody has given to me, on which I am supposed to pay the interest. We assume that the market rate is 10%. On 50 lakhs, the first year interest which I am supposed to pay is 5 lakhs. So the lease liability goes up by 5 lakhs. Debit interest, credit lease liability 5 lakhs, 50 plus 5, 55 lakhs goes. And I have made a repayment of 12 lakhs. So my payment of principal or payment of my lease charges is going to reduce the lease liability. So debit lease liability, credit bank by 12 lakhs. So 55 minus 12 lakhs, 43 lakhs will be lease liability at the end of the period. Next year, on 43 lakhs, what is 10% is 4.3 lakhs will be added, then 12 lakhs which I have paid will be reduced. I am just taking 10% as a simple case, but if I apply this same principle, at the end of the lease period, it should be 0, outstanding amount should be 0. If it is not 0, I am not using effective interest rate method. So I have to identify what is the effective interest rate method by which the inflows and outflows will be discounted exactly, and then apply that method rate of interest for the purpose of recognizing the interest on lease liability and adjust the lease payment against the lease liability. So one side I have considered the lease liability accounting. So what goes into my P&L is not rent. What goes into my P&L is nothing but interest on the outstanding liability. That is alone goes to my P&L. So liability side is over. But in asset side we have created an asset for 60 lakhs, 50 lakhs. What to do with that? Because it's a right of use asset and we have concluded that is an asset, that asset should be depreciated over the 5-year period. So you can use your WDV method, you can use your straight line method, whatever you wanted to use, you can use, depending upon what is the economic pattern in which the benefits are coming. Why I am using this word is that if I am having a lease of premises, I don't have anything other than equally the same benefits is coming to me. So straight line you can recognize the depreciation. Assuming that what the leasehold rights which I am taking because everybody says, thinking that lease means lease is only land and buildings. Suppose if I have taken a right to distribution of a film for 5 years, that is also right to use asset. Whatever is the amount which I am going to pay should also be tested whether it gets into that. Assuming that the way in which we are agreeing is that revenue share, whatever comes in, we will pay 50% to you, 50% for me. There is a minimum guaranteed amount which I will pay. Whether that will also fall into the lease accounting under 116, we have seen that yes, it also falls into that category. But the way in which the revenue comes, first year of release or first what we call first show, first ticketer, that type of revenue being generated initially high and over a period of time low. Like old movies are again coming back and we are still, it has a viewership, but the revenue generated may not be during what it has generated in the first release. So to that extent, you can also use an economic pattern for amortizing your or depreciating your asset. Both are permitted, but normally the way in which I have seen the cases are leases relating to land and buildings are majority of the cases. All other cases I have not seen so far, except only one case which people have asked me. We are getting a license for an ERP software and that license is for a period of 3 years. Whether that will also comes, because it's a right of use asset, that ERP software cloud based can be used, whether that will fall into leases, whether I have to create anything. So previously the license fees has been charged up and some people have felt that because it's a 3-year agreement, it has to be capitalized as an intangible asset and amortized over 3 years period, equivalent, right? Both are same. Either I charge it year on year or I capitalize it and charge it one third, effect will be the same thing. The second option, there will be a ballooning of the asset as well as liability, which somebody may not be interested in doing it. When we have assessed, we concluded that this license in that particular scenario, I am not saying in all cases, in that particular scenario is not a license like what the client has assumed or the auditor has assumed. When we have looked into the terms and condition, it said that the license is for a period of 1 year and every year it will be renewed. But if you are making the payment for 3 years, we will give a concession. So that's the reason why client has paid 3 years agreement, but the license is only for 1 year, not a 3-year agreement has been made. Every year the license has to be renewed, but the figure has been already paid. Then we have concluded that it will not be a lease. It's a license to use that for which you have actually paid. And there is a practical expedient given in the standard which says that if a contract is for, or a lease is for a period of less than or equivalent to 12 months, you can follow the existing principle of charging straight away to your P&L without creating a lease asset, right of use asset and a lease liability. So we have said that you can use the practical expedient because every year it requires a mandatory renewal. If you don't want the renewal, you can issue a notice and then get back the refund. So that means it's not a 3-year contract. So 12 months contract, you can still go for that. Another factor where this lease says is that, again a practical expedient which has been given, that standard says, suppose if it is a immaterial items, it's not very huge item, you are entering into very immaterial items, then you can also say small value items or small value lease agreements can be ignored from application of Ind As 116 and you can still have the existing principle of treating it as a normal leases. It is also possible to do it. There are two practical expedient given. One is a small value leases and another is leases with a short term. So both cases you can follow the existing principle. In all other cases, right of use asset has to be recognized, it should be depreciated over the period of the lease, lease liability should be accounted, the interest in expenditure has to be accounted, lease payment should be adjusted against the lease liability. So nothing will come as a rent. So when you are practically looking into a financial statement, what will happen? The company might have already accounted that as a rent expenditure in the P&L account. So whatever they have accounted as a rent has to be reversed by crediting the rent expenditures and should be debited to lease liability, and interest on the lease liability should be created. So to that extent, it goes as a principal adjustment plus interest adjustment. That is what the requirement of 116. Now, let's go into this standard. Whatever I have not covered in this standard, let me just try to find out. And let me also try to give some sort of Excel working and journal entries, if possible, whatever I have explained in the slides, provided time allows me to go up to that level. As we said, no more classification of finance and operating leases. All the leases are only leases. Either it will create a right of use asset and a corresponding lease liability, or it will be only a normal finance lease type of thing. So naturally, when it's a finance lease, ownership is transferred, so you recognize that as a normal case. Both cases, you will recognize the asset. In one case, the asset will be recognized, which is a physical substance. If you conclude that you don't have, the ownership itself is being transferred. The other cases, ownership is not transferred, only the right of use asset is there. It's like an intangible asset. But having said that, what is the presentation required on the face of the balance sheet? Can I add it to intangible asset, or can I add it to property, plant and equipment because it's relating to a land and buildings? One of the guidance, it's not came as an authoritative guidance, but the way in which it is being used in foreign countries is that right of use asset will also be shown as a non-current asset, as a separate item on the face of the balance sheet, as part of PPE or not as part of intangible asset, but on the face of it, right of use asset as a separate line item within the non-current asset. As we said, we will depreciate the right of use asset and we will recognize the finance cost on lease. Both will come into the P&L of the lessee. Just for your understanding, how the balance sheet will look like. Under Ind As 17, I have total existing assets. There is no right of use asset. So equivalent to that is my existing equity and liability. If it is 1116, same balance sheet, existing assets will be 38,715. Right of use asset I recognized based on net present value of the future lease payments comes to 14,500. So I debit right of use asset and credit lease liability. So the balance sheet size actually goes up. Once the balance sheet size goes up, all related issues of ratio analysis, impact, asset coverage, whatever, business valuation, loan covenants, everything will come into the picture. So this is on the balance sheet. When we come to the P&L, existing profit is 7,421. Operating lease expenses which I have paid is 451. So I have reduced it. My EBITDA is 6,970. I will not charge any depreciation on right of use asset because that is concept is not there. There is no lease liability concept. So my profit for the period will also be 6,970. This is profit before tax. Then you can have the taxation, etc. If you compare Ind As 1116, profit before lease accounting is remaining the same. Operating lease payment will be nil because we have to allocate the rent expenditure towards the payment of principal and payment of principal lease liability and interest on lease liability. So it is nil, but it allows me option to exercise in case of low value asset or short term leases to continue the same principle of charging as an expenditure, assuming that in this case that comes to 98 lakhs, the balance is your EBITDA. Then 14,500 was the asset recognized, assuming that it's a 10-year lease, 10% on a straight line, 1,450 comes into that, and my interest rate is say 10%, I have taken it as a 10%. On the existing liability of 14,500, what is the interest which we have to consider? That comes into the picture. I think that this calculation of 140 is also wrong. It's also 1,450 if I am not wrong. Because 14,500 on 10% will be 1,450. So this amount will be reduced and balance will be the profit for the period. So what is the impact which is happening? EBITDA goes up. because what is charged as an expenditure is now being treated as a depreciation recovery as well as interest recovery. So EBITDA goes up. But profit in the initial years of lease accounting will come down dramatically because depreciation is upfront, interest is also upfront on the loan amount outstanding. So it will be very huge on the initial periods charged to P&L account. So profit or your earnings before tax will be lower in the case of lease accounting, one as per 116. Now, similar thing, EBITDA will be having an impact, interest cover will have an impact. What is the free cash accruals which will be having front loading of expenses is what we have seen. Profit before tax in the initial years will be lower. Operating cash flows will have an impact. Financing cash flows will also have an impact. So this is the implication of 116. So it says identifying a lease. If there is an identifiable asset and you have the right of control or of control to use that asset, then whether you are getting substantially all the economic benefits from the use, then it becomes your asset straight away. If you are saying no, you have only a right to use it asset, a right of use asset as per 116 will be accounted for. Lease term, similar situation, there is no difference. Standard says lease term is not only the principal period for which you have agreed, but also what is the further period where the lessee has the right to terminate as an unilateral basis. That means initial lease agreement says first 5 years, the agreement is for the period of 5 years, and after 5 years the lessee has the right to renew it for another 5 years, and lessor doesn't have a say on that. Then the lease term has to be assessed. Initial 5 year plus another 5 year, provided you have evidence that the lessee will renew that for a further period of 5 years. For example, if a software industry has taken a premises in a SEZ or a STPA and it has incurred huge interior cost, or it has taken a warm shell and it has actually furnished the entire thing, and it has we assume that they have incurred more than 10-12 crores on the furnishing of the entire premises. If I say contract is for 5 years and again it can be extended to another 5 years at the option of the lessee, we have to assess, having incurred 12 crore of expenditure, whether I wanted to amortize the entire thing within 5 years or I wanted to do it for 12 years, 10 years. So on that basis there could be an indicator that the lessee will continue to exercise that option. The lease term will be 5 plus 5, 10 years, and the amortization also happens. One of the cases which we have seen is that when this impact of Ind As 116 has been applied, the client, our CFO and his finance team has told us, sir, we are having, because there is an exemption available, short-term leases. So majority of the leases are cancelable leases, sir. So when majority of the leases are cancelable, as an auditor will expect that what is cancelable, what is not cancelable, that has to be bifurcated. But they said that it is not material to us for the balance leases. So accordingly, we will not do any Ind As 116 adjustment in the financial statement. We wanted to get the exemption by saying it's a short-term contract, cancelable contract. I only cautioned one thing, sir, what you wanted to achieve is perfectly fine because you wanted to avoid the complexity of calculation. The moment you conclude that my leases are cancelable for 1 year, the unamortized leasehold improvements, which was 12 crore, now assuming that it's 8 crore, the entire 8 crore has to be charged to P&L in the current year itself, because you don't have the right of using the asset for 1 more year. You lose the control. Unless you say that out of that 8 crore I will be able to replace the items or take the items and you reuse it in some other places, you can still say there is an economic value. All other items should be charged in one single year. The moment you are concluding in the first year itself, it has to be adjusted in full. I was thinking that the client will take a different view, and then they will go into 116. The same argument came in 2-3 client cases. So one client has said, we don't mind taking the hit. It's a cancelable lease. The reason is, once you apply this standard is being applied as a new accounting standard. And it gives a transitional adjustment, which allows you to have the cumulative impact being charged to your opening retained earnings. So instead of charging the depreciation each and every year, 8 crore has to be amortized over the next 8 years, a smart CFO and CEO team has said, because it is adjusted against the retained earnings, I don't have a pressure of performance of minimum 1 crore for the next 8 years. Because the depreciation charge is not going to be there, my profit after tax will be higher. So I don't have a problem. As far as the income tax is concerned, again the depreciation is as per section 32 of the Income Tax Act. So I am not going to lose anything. They have said that for my business case, this is the perfect choice. I wanted to go for adjustment by saying that it's a short-term lease. Perfectly alright. Other case they have said, no, it is not possible because our MIS has been already drawn up for the next 5 years, and this is what we have forecasted to our investors and analysts, and we don't want it to go back. And on that basis, their assessment is, okay, we will consider the lease term as per the existing terminology and we will not go for a different thing. Again, I am saying that possibility is there to interpret either way, but it should be supported by facts and circumstances of the case, and based on which the impact will come into the picture. So lease terms we have discussed. As we have said, initially you have to identify the right of use asset and lease liability, which is nothing but the present value of the lease payments, and then you account for all the items. Actually, I have taken one case where they have said that 5 years is the lease period and 1,25,000 rupees is being paid annually as a lease rent. Discount rate we have assumed as 10%. Tell me what is the initial measurement, that is what is the right of use asset and your lease liability. We said that we have to find out the present value of the future lease payment. So 6.25 lakhs is the total lease payment, but the present value at 10% discount rate, all of you might be knowing how the discount rate applies to each period. If it is 0.909, then again for the next period is 0.8264, that's the present value, multiplied by the actual outflow, the present value of the amount comes to 4.73 lakhs. So the right of use asset will be 4.73 lakhs and the lease liability will be 4.73 lakhs, which you will recognize as the asset. That's the thing to understand for our easy understanding. That's what the entry which I have passed. Debit right of use asset and credit lease liability. And then subsequent measurement, right of use asset should be depreciated over the useful life, and if the lease term has to be extended, take that also into consideration. Impairment should also be tested, because the moment you are considering that as an asset, impairment testing should also be there. Lease liability should be increased by means of interest payment and reduced by means of actual payment. So that is what we are trying to do this. I said inflows and outflows should be exactly discounted to zero. That is what we have tried to identify for the 6.25 lakhs. So 4.73 is what we have assumed as the net present value on the date of initial measurement as a lease liability. That should be increased by the actual interest which I have to make payment. That is 10% on the lease liability of 4,73,000, which is 47,385. But actually I am making a payment of 1,25,000, which is reduced, and to that extent there is a net decrease of 77,615 on the lease liability. Closing lease liability is 396. On 396, 10% is added, minus 1,25,000, that gives me 3,10,000. Exactly, that is the way in which it is being accounted. So at the end of the period, lease liability will be zero. My interest expenditure has already gone, and accordingly 6,25,000 which I have paid will be equivalent to 151,152 plus 4,73,848. This is the
Any deposit is paid If any deposit is paid by the lessee.
So deposit actually comes into a separate standard, sir. Ind As 109. So we will not adjust here. Assuming that I have paid a rent-free deposit of another 1 crore for taking this. So maybe in this case we will assume that another 5 lakhs I have paid. That whether I have to consider that also into this, but rent, it's a refundable deposit. Whereas what we are assuming is that inflows and outflows, which will not be refunded. So when the refundable deposit has been given, if it is rent free, Ind As 109 says that you have to consider time value of money. There I will do a separate accounting. So I will not merge it with the lease accounting. If it is a low value items, as I have said, you can follow this existing method or you can consider recognizing this. But what it says is that option can be exercised lease by lease basis. So each lease you can consider whether it's a lower value or higher value. If the only point which they are saying is that if there is a sublease condition is available, I took the lease and I am doing the lease accounting and I have the right to sublease it to somebody else, then the option is not available. Only if I am using it only for my purpose, it is available. If I am having the sublease rights, then it is not available. Short-term leases is 12 months. Here if you say, this is an example which you have to see, low value assets, they say lease by lease you can apply your exemption. But if you see the short-term leases, they are saying by class of asset. So that means I have 50 leases and I am saying some leases are below 12 months, I am exercising that option, but underlying asset is similar land and buildings, so I cannot have the option to be exercised. Okay, underlying asset based it has to be done. If there is a purchase option at the end of the period, it is not a short-term lease. It should be reviewed again whether it gives substantially the risk and rewards of ownership is being transferred rather than right of use asset. The transitional provision says you can do full retrospective application. What do you mean by full retrospective approach? I will assume that this standard is applicable right from the inception of the lease. I have taken the lease 7 years back, or whatever leases which I am having which is still open, I will go back to the date on which the lease has started and apply this standard. Identify what is the right of use asset after all the depreciation till the date of transition and consider that as my adjustment in the opening retained earnings, and whatever finance liability which I have to recognize less the payments which I am doing, interest accounting which I am doing, I will do an adjustment in the opening retained earnings and state what is the closing lease liability as well as right of use asset in the balance sheet. This is method called full retrospective approach. So that means not only current year, this is 116 is applied, current year also applied, previous comparative period also adjusted, opening balance is also adjusted. So all the periods is adjusted. It is called full retrospective approach. Another approach which says is a modified retrospective approach. This approach is normally used by majority of the companies. What they simply say is that whatever is the impact, I will not restate my previous year numbers. If it is relating to up to previous year, I will adjust against the retained earnings. What is relating to the current year, I will charge it to the P&L account. So this is allowed as a modified retrospective approach. In the modified retrospective approach, they have given two options. Where they have said, if the lease has started earlier, you have the option of ascertaining what is the present value of the lease liability as well as what is your balance undepreciated right of use asset. There could be a difference because depreciation is being done on a straight line basis, whether interest is accounted on a effective interest rate model. So there will be a difference between these two and the difference will be adjusted in the retained earnings. That could be one option which is available. Other option is forget about whatever you wanted to do. What is the balance minimum lease payment which you will make? Discount it for the time value of money. Take that as a right of use asset. Equal amount will be your lease liability. Both options are available. Practically every company wanted to use modified retrospective approach with prospective adjustment for outstanding leases. That's what I have also seen for 2-3 companies where we have helped on For the past 2 quarters we have done it. Even for the third quarter also we are going to do the same thing. When we have explained that, they felt that I don't want to disturb the earlier number, I don't want it to have the impact on retained earnings. Let us start as if this is a starting point for the uncompleted period of lease. We will recognize it. Both are available in this. Exactly, that is actually happening as by means of journal entry. Maybe I will leave this journal entry also for you to understand because of the time factor. So what is the key impact of this lease accounting? As we have seen, profit in the initial year of the leases will be lower, depreciation is charged high, outstanding lease liability interest is also charged high, but EBITDA will go up in every case, because what is charged as a rental expenditure is now split between depreciation and interest expenditure, so EBITDA goes up. The return on capital employed will come down, because when you have a long-term liability to repay a loan, lease liability is also a loan or borrowing, so it will also be added to your capital employed, and accordingly whatever your profit which you are earning will be lower, because when the moment the liability goes up, your return on capital employed will come down. Net assets will also come down, because your lease liability will be a reduction and your depreciation will be on straight line. Lease liability will be reduced only to the extent of repayment, so the net assets will come down. Net debt and gearing ratio will go up, because debt goes up, the gearing ratio will also go up. Current ratio will come down, because a portion of your lease liability will be considered as a current liability, whereas your right of use asset will be only a non-current liability asset. So to that extent your current ratio will come down. Suppose if the lease is entered into foreign currency, the profitability will also have a volatility. If it is in Indian currency, nothing will have an impact. Suppose if you have taken a foreign currency repayment terms and you have taken a lease on that basis, then there could be a volatility of profits because of the forex rate impact. Asset retirement obligation may go up, but of course even if I am using the word asset retirement obligation, should have been the same, because the existing lease standard also says that if you are taking a premises on lease and the lease contains a term for restoring the site after the end of the lease period, you have to take that as part of your asset and depreciate over the lease period. Same logic is there, but it is not very explicit. It's only talking about in Ind As 37 and also to some extent under Ind As 16. But here it says very clearly that you have to identify whether there is any asset retirement obligation, and that should also be considered when you are recognizing your right of use asset. And majority of the cases, client started renegotiating the lease agreements to avoid the implications on their financial statement on this. This is on Ind As 116. And in summary, we are on the lesser side. I have not spoken anything, because on the lesser side the same accounting principle will continue. It is not change, or it will not have any major impact. On the lessee side, we have a completely different accounting principles comes into the picture. So if there are any questions, I will be happy to take those.
Implication on tax.
Okay, what is the implication on the tax? Suppose if I am doing the Ind As 116 accounting, what is the implication on the tax? As far as the book profit is concerned, this may reduce my impact of book profits, because I am following accounting standard. Accounting standard says that I have to charge depreciation on right of use asset, and it also says you have to account for the interest. So to that extent, my book profits will come down, which we have seen in the first slide on the profit and loss account. EBITDA will be high, but profit will be low in the initial period. So MAT, if the company is under MAT, the minimum alternate tax impact will be lower. When it comes to current tax computation, the entire lease accounting goes with the principles of ICDS. ICDS has not come out with the lease accounting, it's going to come out with the lease accounting. As a simple principle, it says if it is an asset which is capitalized, you are entitled for depreciation for the lessor, not for the lessee. So that means whatever you are accounting here will not have any impact for the lessee's books of accounts. So what we have done is, in current tax computation, whatever adjustments we have done, one is depreciation we have charged to P&L, interest we have charged to P&L, we have added back to the book profit, and we have reduced the entire amount of lease payment, which is rent payment, as an adjustment, as an expenditure. So net impact. So that means we are going back to the old principle. Nothing is going to have an impact. MAT companies will have the benefit in the initial years. Yeah. Any other questions, sir? So presentation of lesser will remain the same, because for him it's an asset. He has only given that for usage for a particular time. So the presentation will not make any difference for him. And when I have given it on lease, there is a requirement of showing the assets which is given on lease, which is coming under Ind As 16 requirement also, as per Schedule 3 requirement also. You will only disclose these are all the assets which has been given on lease. For the lessor, there is no difference. Lessee, they have to, on the balance sheet, on the asset side, right of use asset has to be brought in, and on the liability side, the lease liability has to be brought in. P&L account, as I have shown, depreciation will also be added, and the interest on lease will also be added. So this is on the P&L presentation. Disclosure, you have to talk about what is your accounting policy, what is your right of use asset, how you have recognized that. A lot of disclosure has to be given in the lessee's books of accounts. Because for the first time you are bringing right of use asset in the balance sheet. How it is recognized, you have to bring in the concept. How it is depreciated, whether it's a straight line method or you are using some other method, you have to brought in. And lease liability adjustment, how the interest has been accounted based on effective interest rate method. So that disclosure should come in. And what is the closing balance, you will talk about. And anyway, as a lease, what is the repayment which you are having should also happen. One thing which I have missed, because once you have asked about the presentation, I was just thinking about it. The previous lease standard says if there is an escalation of rent, it should be straight lined. Assuming that 5-year lease, every year 10% increase, then first year is 12 lakhs, the second year is 13.2 lakhs, like that we will go on adding for the 60 months, divided by 60, into 12 is the charge to each year. But the actual payment is only 12 lakhs. What I am accounting as a rent expenditure, minus the 12 lakhs, we will create as a lease equalization reserve, or we are creating that as a rent straightening liability, whatever terminology or nomenclature which you have used. No more that straight lining of rent will be applicable, for a simple reason. Whatever amount I have paid has to be apportioned between lease liability and interest, and accordingly rent straight lining will not be applicable. And on the date of transition, in the balance sheet, if I have a rent equalization reserve or rent straight lining liability, that should be reversed to the retained earnings, because it is no more a liability according to Ind As. When you first apply this, it has to be reversed to your retained earnings. So credit retained earnings and debit rent straight lining liability. So that is one thing which, otherwise this is the presentation on lessee's accounts. Lessee's accounts, a lot of disclosures will come into the picture. Any other questions?
You have discussed about land and buildings. What about equipment?
Lands are allocated on 99 years.
Little bit louder, sir.
Generally, in North Indian states like Uttar Pradesh, land is given on 99-year lease. How do we deal with it?
Okay. That's an interesting question, because this is not an issue coming up with this present standard on leases. People are questioning, when I took an asset on 99-year lease, previously we used to show that as part of leasehold asset in our property plant equipment. There are two schools of thoughts which has been discussing this. One of the school of thought is saying that you have only a lease and does it creates an asset, and accordingly whatever amount which you have paid is nothing but prepaid rent or prepaid lease payment, and you should not consider as part of property plant equipment. You should treat it as part of your asset and current asset, non-current classification, whatever. After the amortization, whatever balance amount will be done. That is what even before this standard has been coming into the picture. So to that extent, I have already prepaid an amount. In this case, it is a rent which I am going to make subsequently year on year. When the prepaid payment has been already made, that will come into the same accounting principle. But there are some companies which wanted to argue based on an US GAAP explanation, where they have said if the lease has been given for more than 50 years, almost the ownership itself is transferred. And accordingly, considering that as an asset and amortizing over the lease period is not a wrong accounting. So some companies has taken that view also. If you ask me whether that is wrong, I will say that by facts of the case, you can still go for it. Because the case which I have evaluated in one of the scenarios is that they have given the land on lease for 99 years and the lease agreement says automatically it will be renewed for another 99 years. So almost perpetual. So that will not have any impact on this accounting. Only if you are having a future or minimum lease payment which will happening over a period of time, then you will create a right of use asset or something like that. Yes, sir.
We have discussed about land and buildings.
Hmm.
How about equipments, especially mining equipments?
Again, same logic, that's all. So when that is what I started to mention. If you are saying that my accounting is only in respect of land and buildings, and if I don't have a lease for land and buildings, the standard is not applicable. If we are concluding that, we are making an error, because any contract of lease or agreement of lease which gives you a right to use asset over a period of time, it is a controlled, there is a control over the assets use. For 5 years it is an exclusive right for you to use it. Assuming that I have taken a planter machinery on lease for 5 years, same rule will apply, as long as it is not cancelable. If it is cancelable by either party, you will not apply that rule. So what will happen previously, if you have treated that, because why we have to talk about the lease of a property, assuming that the useful life of the asset is 10 years, but I have taken only for 5 years. So that means for the entire useful life it is not with me. If you recollect the first slide which I have seen, identifying an asset, you have identified an asset, but what is the terms and conditions of that? It gives you the risk and rewards of ownership for the entire useful life of the asset. Assuming that I have taken that machinery for 10 years, where the useful life is also 10 years, and my repayment, the lease payment which I am doing, if I do the net present value, it is more or less equivalent to the value of the asset. That evaluation shows that I am taking the risk and rewards of ownership. Whereas the asset can be used for 10 years, but I am taking it only for 5 years. But 5 years it's a non-cancelable. To that extent, that 5-year lease has to be accounted as per 116. Same principle we have to apply. What is the present value of the lease payment which you will make? So it applies to every lease. That's the reason why I have even gone to the extent of taking an example of software license. So where I have taken a license for, or maybe a technical know-how to be used for 5 years, and for which I am paying month on month some amount, fixed amount, not based on production royalty. If you are talking production royalty, it goes to some other standard, revenue recognition standard. If I am talking about paying a fixed amount, I will evaluate and I will conclude that it will be lease of a technical right, technical know-how. Could also be a lease. Right of using that technical right. Any other questions?
Single bulk payment has been made.
Sorry?
Single bulk payment has been made by the lessor to the lessee, which will enable for 5 years duty.
That is what he was talking about, 99-year lease. Similarly, when you are saying it's a 5-year lease, I have already prepaid the entire amount. Okay? That entire amount which I have prepaid, if I have to recognize the revenue, what is the minimum lease payment which I have to make is to be discounted. Right? I have already paid that amount. That amount is a prepaid lease income, will be straight away accounted for, and it will not come into this adjustment at all. So last question I will take, somebody was... Yeah.
One asset is transferred to another company without any lease rental for 5 years usage, which is free of cost. Then it will be again taken back.
Okay. So maybe closely held companies could be a scenario where one company gives an asset for use in next 5 years, but no charge is being taken. Whether that will come into 1166 assessment, you have to see what type of agreement they have entered into. And if there is no minimum lease payment which is being done, there is no lease asset, right of use asset or lease liability. But at the same time, other standards will have an implication. For example, fair value measurement standard for the party who has given it on lease, whether his revenue should be considered differently because he is giving free of cost, whether any value has to be attached to that. Because the fair value measurement standard says a transaction with a related party, the transaction price is not equivalent to the fair value of the consideration. Could be an issue which we have to take into consideration, but it will not come into that because there is no outflow.
How it will be treated in the lessee's books, sir?
Sorry?
Lessee's books.
In the lessee's books only I am saying. As far as the lessor's books, he will consider that as his own asset and he will depreciate. So in the lessee's books, I don't have an outflow.
Any grant kind of.
No, grant will come only if, because the standard on grant, Ind As 20 is only talks about government grant and assistance. If one company has given that to another company, it is not a grant. So accordingly, Ind As 20 cannot be applied. Yes, sir. Last one.
Yeah, last.
Yes.
How does the current ratio come down? Because both are long term, right? One is right to use.
But what happens is, Schedule 3 requires you to show 1 year repayment into non-current liability category. So to that extent, there will be an issue. Yes.
Right to use grant.
Sir, actually 1 o'clock was the time. We are 17 years, okay, but I am happy to answer all the questions as long as you are ready to delay your lunch also. Okay.
Right to use grant under co-branding arrangement, where the remuneration will be based on sale for a period of 3 years. How will that get addressed?
Normally it's a royalty arrangement, sir. That will not come into the leasing arrangement. Because one of the exemptions which is given in this, that is the reason why when I was saying technical know-how being given, I cautiously use the word fixed amount has been paid. So then 116 will apply. Suppose if I am paying the consideration or the lease charges by saying based on some parameters, revenue or production, then actually the standard excludes that. I have not included a slide on that. So that will be considered as a royalty payment. So your existing arrangement of royalty, say for example 1% of the total revenue will be charged. You will not recognize any right of use asset or lease liability. Yes, sir.
Is there a possibility now the companies can go in for sale and lease back transactions?
Still it is possible.
Which happened some 20 years back in Mumbai.
Same principle is also covered in this standard. You will go and do the same accounting principle. What will happen is the lessor himself will account for 116 because he has sold and taking it on lease back. So he becomes a lessee. So he will account it according to this standard. And the principles of you have a profit or margin adjustment, everything will apply as per the old standard. They are providing for that because in commercial parlance that is still the principles or that type of transactions are existing. So they have taken that also into consideration. So thank you so much because I never thought that so much of interaction will be there for these two standards. I am very, very happy that interaction is so high, and because of that whatever time I have spent, I believe that it's well spent by me. Thank you for making that strong impression on my mind. Thank you so much. These slides have been already shared with the institute. As per normal practice, they will upload it in the website. You can download it from the website, and it contains my contact email as well as contact the contact number. In case if you are having any practical questions and you wanted to have that to be clarified, you are most welcome to write with the background of the case, which I will read and then we will discuss over phone. So I am always available for that type of help also for you. Thank you.
now welcome all to the post-lunch session, and I welcome Venkat Subramaniam sir to the dais. A brief note on Venkat Subramaniam sir. Venkat Subramaniam sir hold a diploma in IFRS from ACCAS from UK, and sir has an All India rank holder in Chartered Accountancy course, has an overall experience of more than three decades. He is co-opted as a special invitee to the Accounting Standard Board of the Institute of Chartered Accountant of India for the year 2019-20. He is a visiting faculty at the CA Institute for the Ind As certificate course for the last 10 years and has conducted specialized course on financial instruments for several banks and financial institutions. And sir has also authored a lot of number of books, and we welcome sir to start the session.
Good afternoon, all of you. It's really a pleasure to be here at the Institute once again. May I kindly request you to come a little bit closer? See, the reason is, by mistake, I forgot to bring the connector to the iPad, so where I normally used to write, so that, and I can expand it, so those who are sitting in the back can also see, but unfortunately, since it is not there, I will probably make use of the board, and the visibility may be far restricted, so I apologize for that. I'll see if I can get it here before 3:30 at least in the okay. So the topic is financial instruments as per the Ind As 109. 109, Ind As 109 is the new avatar of the previous standard as far as the Ind As is concerned. There is no previous avatar, but as far as IFRS is concerned, the previous avatar used to be IAS 39. I'm sure many of you would be familiar with some of the nuances of IAS 39, which used to be the previous standard. But fortunately for us, I always say it is fortunately for us, we do not have to unlearn IAS 39 in order to learn IFRS 9. So we are now presented with only Ind As 109, which is an exact replica of IFRS 9. So far so good, we only have to do that. Now the closest resemblance to these financial instruments standard as far as AS is concerned used to be, any idea what used to be the equivalent in AS? Is there any equivalent at all? Or any idea? 30, 31, 32. So that is the answer I was expecting. So AS 30, 31, 32 used to be the previous standard as per AS, but it was supposed to be implemented, or it was supposed to come into effect with effect from 1st of April 2011, and it was withdrawn with effect from 31st March 2011, which means it never saw the light of the day. So we never had this AS 30, 31, 32, and AS 30, 31, 32 were the cut copy paste of the previous version of IAS 39. So, and that happened in the year 2009. Okay, immediately after the financial crisis. So after the financial crisis, IAS 39 underwent a lot of change. So which means that we are fortunate. That's why I said fortunately we are fortunate enough not to know about IAS 39 and only read about IFRS 9 or Ind As 109. So when I say IFRS 9 and Ind As 109. So pardon me, because I will be using it interchangeably, because it is exactly the same, except there is one small difference. Okay, there is only one difference, which is really not relevant for us. So I don't want to start with that one, so as to confuse you. I will talk about it a little bit later. Now this Ind As 109 is a very interesting standard. Okay, the reason is because we have been used to dealing with the accounting for investments in a particular way all along as per AS, and this one completely negates some of those concepts. Okay, like for example, I will start with this one. Supposing there is an investment made in a debt security. Okay, so debt security, we call it bonds. So here I call bonds in India means it's all Government of India bonds, but in the US it means even private sector whatever is issued is also called as bonds. So when I say bonds, don't think always about Government of India bonds. Just think that it is a debt security. That's what I mean. So if there is an investment in debt security, say for example, the face value of which is say 100 rupees, maturing after 3 years, right? And it is purchased today at 85 rupees. Then the way we account for it is, and let us assume that the coupon is say 6%. Let us assume the coupon is 6%. So year after year you will get 6 rupees as interest income, right? Because interest is always calculated on the principal, which is 100 rupees. And at the end of the third year, you will be receiving 100 rupees from the company. The company gives you 100 rupees. So we have been all along taught, and also we've been accounting as 6 rupees as interest income. Is there any two ways about it? Is there any other opinion about that? We have been accounting for interest income at 6 rupees all the 3 years. And at the end of the third year, when you receive 100 rupees back from the company, your investment account stands at only 85 and you are receiving 100 rupees back. So how would you account for that 15 rupees? Profit on redemption. Profit on redemption, or so to say something like capital gains, because it's not part of yours, so capital gains. Now IFRS 9 or this Ind As 109 tells you that this is completely wrong. This accounting is completely wrong, because what you receive as 6 rupees year after year is not the only interest income. There is a hidden interest income also there, because this 15 rupees, which is called as the discount, initially there is a discount. So this discount will have to be amortized over the life of the asset. We'll have to has to treat this also as interest income, because in effect this 15 rupees represents part of interest income, and that is why a new concept is introduced which is known as effective interest rate. So what you do, you have to find out the effective interest rate for all types of instruments, for all financial assets. You will have to find the effective interest rate. This effective interest rate is nothing but your IRR. If you want to take the case of Excel, it is just the IRR what we have as internal rate of return. It is also known as YTM, or yield to maturity in the bond market. Right? So it is all the same, and the accounting standard calls it as effective interest rate. So we have to compute the effective interest rate on day one on which you purchase the asset, financial asset, and this is something like which is cast in stone, which means it never ever undergoes a change. Whatever is computed at the beginning of the period in which the financial asset is purchased, that never ever undergoes a change, it remains the same. You will be accounting for the interest income on the basis of the effective interest rate. So you start with 85, so now there is 15 rupees. 15 rupees will have to be treated as part of the interest income over the remaining 3 years, which means roughly 15 divided by 3 or 5%, right? So 5% should be added on to your coupon of 6. So which means your effective interest will hover around 11%. It won't be exactly 11 because this is done not on a straight line basis but on a yield to maturity basis, which means initially it will be low, subsequently it will be more in terms of absolute number, but in terms of percentage it will be the same. In terms of percentage it will be the same, right? So this is one basic difference between how we have been accounting for interest income and how interest income will have to be accounted in future. So this also means that the investment account, which starts at 85, will go progressively and it will reach 100 rupees at the end of the third year, where you will be receiving 100 rupees. So there won't be any capital gains or any profit on terms or whatever. Okay. So everything will be accounted for as interest income and interest income only. So at the end of the first year, there will be two components. One component goes towards increasing your interest income, and this other side of the same component is the one that goes towards increasing your cost of investment or the value of your investment. So the entry that will be passed will be debit your investment account and credit interest income. So effectively the interest income will be shown at the effective interest rate. We will see some examples of that shortly. So I just wanted to give you an overview. Now let us look at a little bit about the genesis of this 109 itself. Okay. Now this 109, as I told you, is just a replica, copy paste of IFRS 9 as it was announced on 24th of July 2014. Now the previous avatar of IFRS 9 was IAS 39. Now this IAS 39 itself, what happened after the financial crisis, or rather actually the entire process of the project started as early as 2002 itself. 2002 itself, the standard setters sitting on both sides of the Atlantic Ocean, namely IASB and FASB, these two people joined together and then they wanted to create an accounting standard on financial instruments. That was the agenda. This agenda dates back to as early as 2002, but then it didn't take off seriously. But after the financial crisis, there was a rude awakening. So both these standard setting bodies came together and then said, okay, we need to expedite this project, and as a result of which what they did was, they came up with some substantial changes in the year 2009, and that was the first amendment made to IAS 39. So as and when these amendments are made, that portion would be carved out of IAS 39 and it went and formed part of IFRS 9. That's how this developed. Then 2010 was the second installment. 2013 was the third installment relating to hedge accounting. All the changes relating to hedge accounting were made in 2013 and that was moved to IFRS 9. The final phase or the final installment came on 24th of July 2014 relating to impairment. At this point of time, both of them, that is IASB and FASB, they agreed to disagree on impairment portion. So today what we have as part of impairment, which forms roughly 1/3 of the entire standard, there is a substantial difference between the US GAAP and IFRS as far as impairment provisions are concerned. Now, I told you that there is one difference between IFRS 9 and Ind As 109, right, when I started this. When the hedge accounting changes were introduced in 2013, there was one particular type of hedge which is known as the fair value hedge for interest rate risk. Fair value hedge for interest rate risk at a macro level. So that means normally there is a hedging instrument for a hedged item. There will be hedged item and there will be hedging instrument. So there can be a one-on-one hedge accounting, which means for every hedged item there will be hedging instrument. So that is called as a micro hedge or a one-on-one hedge accounting. But then if you are trying to do a hedge accounting for interest rate risk using fair value method, then you can also have a series of hedging instruments hedged with a series of hedged items. Okay, so I'm just trying to give you an overview of that. Okay, so don't get into the details. It starts talking on its own suddenly. So, so if we are trying to do a macro hedge, okay, this macro hedge is what is not covered so far, even today, by IFRS 9. So, when they came out with the final installment, they said, okay, since that project on the macro hedge accounting is not complete, we will allow the users to continue with IAS 39 as far as hedge accounting is concerned. Why? Because one particular aspect of hedge accounting is still not covered by IFRS. Is this clear to you? So there is an accounting policy choice that every entity can exercise, because it's a choice, it's an option that is given to you. This is only from an IFRS 9 perspective, not from Ind As 109 perspective. Okay? So there is an accounting policy choice that is given, by which the entity can decide, okay, I don't want to go with IFRS 9, I will continue to use IAS 39. They can make that choice. But that choice is not available in India. Why? Because we don't even have a precedent IAS 39. So right now, we don't have an effective mechanism to handle fair value hedge accounting at a macro level. Okay, so this is just the genesis. Just keep it in mind. We'll try to do justice as far as possible, because the topic is quite heavy, and normally this is done over a period of 2 days. So we try to cover in 3 hours here. So I'll try to cover the essence of everything, whatever is needed, so as to enable you to read some of these things on your own later when you go back. Okay. Now, basically there are three components of this financial instruments, Ind As 109. The 3 components are: the first one is classification and measurement. So measurement strictly is covered under 113 because it's part of the fair value. Okay, but then, so you can say for our purposes that classification and measurement is what is the first portion. The second portion is about the impairment, of which I said briefly that it is substantially different from what is available in the US GAAP. The third portion is hedge accounting. Hedge accounting is exactly the same, US GAAP and IFRS exactly the same. Okay, so now these are the 3 components. Now first we are going to see about the first component, which is classification and measurement. Now classification. Now this classification, according to me, even though it constitutes 1/3, I would say this is the most important one, because we need to understand the rationale behind the classification of financial instruments. Why is it so important? Because it is important because the accounting will depend upon how it is classified, how the instrument is classified. Now you all would have studied, you all would already probably know that IFRS is completely a principle-based standard, as opposed to the US GAAP, which is rule-based standard, right? But in spite of that, we had a lot of provisions which are strictly not principle-based. I mean, which are more like a rule-based kind of stuff. Okay, which are not. I will put it differently. Which were subjective and not objective. So there were you could probably interpret that in a different way so as to get a different answer. So those are subjective elements. those subjective elements are now removed completely, are now replaced with a lot of objective mechanism to do the classification. So the classification is now very, very objective. Now, I'm sure all of you know that basically as far as the financial assets are concerned, now let us look at the financial assets. The financial assets are concerned, you have broadly cash. Cash is a financial asset, right? So the definition of financial asset is given not in Ind As 109 but in Ind As 32. Okay, Ind As 32 gives you the definitions. So broadly it is cash. Then you have investment in equity instruments of another company. Don't confuse this with the equity, which is a liability kind of a stuff. Okay, don't confuse this with equity. But this is an investment, which means this is on the asset side. So investment in the equity instruments of another company. Okay. Then you also have a derivative instrument, the fair value of which is positive. So what does it mean? It means the derivatives, the fair value of the derivatives can oscillate between positive value and negative value, depending upon whether you need to give or whether you need to take. So if you need to collect, if you need to receive, then it becomes an asset. So that is the third kind, which I call that as the derivative assets. Usually, all derivatives that are purchased are assets. Either it becomes an asset, or it becomes a complete waste or an expense. So normally it is an asset. Right? And then the last category is investment in the debt security of another entity. So broadly there are 4 different types of investments or financial assets one can make. The first one is cash. The second one is investment in the equity instruments of another company. The third one is derivatives, the fair value of which is positive, so that it is shown in the balance sheet on the asset side. And finally, investment in the debt security of another entity. Okay, these are basically the four things that are considered. Now, as far as cash is concerned, cash is always accounted with a multiplying factor of 1, right? Because unless we're talking about a runaway inflationary economy, 1 rupee is worth 1 rupee only, right? At least today, as of today, 1 rupee is worth 1 rupee. So there is no further treatment. It is treated as an amortized cost, and then you treat it. As far as derivatives are concerned, the derivatives are accounted for at fair value, right? So if there is an increase in the fair value, it is treated as a gain. If there is a reduction in the fair value, it is treated as a loss. Again, irrespective of whether there is a profit or a loss, you will have to value these derivatives at fair value and account for it accordingly. Previously, we used to have a different concept, right? As per AS, what is the concept? The concept is, if it is a loss, book the loss. If it is a gain, don't bother. You should not account for the gain. There is absolutely no rationale, and especially in the Ind As regime, it is just not accepted because there is no hidden reserve. You cannot have a hidden reserve. So if you have to value this at a fair value, there is no choice. Whether it results in a profit or loss, you will have to account for this at fair value. So out of the 4, 2 things are out, right? Now we are left with just a classification of just 2 items. One is investment in the equity securities of another company and investment in debt security of another company, right? These are the only 2 things. Are all of you with me now? Or you say nothing is understood so far? Is it clear? If there is any doubt, please stop and ask me. That will be a great opportunity for me to learn and for others to learn as well. Okay, so please stop and ask questions. Let us make it interactive. Investment in equity securities of another company, investment in debt securities of another company. These are the only two things which we have to now see how it should be classified, or what is the classification process. Okay. Now, if it is an investment in equity securities, then there is no way you can get the money back from the company, right? When will you get the money back from the company? Only once. When that other company is liquidated, is wound up, you will get the money. Otherwise, as a going concern basis, you will not get the money back from the company. Well, you can sell it, that's a different story, but you won't get it back from it. So that means there is nothing like a maturity period for that. There is no maturity period for the investment in equity securities of another company. So that leaves us with just two classifications. One is, you can classify it as fair value through profit and loss account, which means you have to do the fair valuation of the equity instrument, take the difference to the profit and loss account, or alternatively, fair value through other comprehensive income, called FVOCI. Now, if the investment in equity securities is held for the purpose of trading, which means you are going to keep buying and selling that, it is held for the purpose of trading. Trading purpose can be defined, right? So you keep buying and selling, it is trading. So there is no subjectivity here, it's subjective. So I want to ensure at every stage that there is no subjectivity. If you feel that there is subjectivity, tell me. Okay, so that is precisely what this standard addresses. If it is held for trading, the classification there is only FVTPL, that means fair value through profit loss account. If it is not held for trading purposes, then there is a choice that is given to the entity to classify this as FVOCI on an instrument by instrument basis. There is a choice that is given to the investor, that means to the entity, to account for it on a fair value through OCI basis, FVOCI basis, which means the difference between the market price, between the fair values, will be taken to the other comprehensive income and does not affect the P&L. So the choice is given to the entity, and the entity can exercise this choice on an instrument by instrument basis, which means at 10 o'clock I buy the shares of Infosys. I can decide, okay, this I'm not going to do trading on this one, so I want to classify this as FVOCI permitted. At 10:05, again Infosys, the company can buy Infosys shares and then say, okay, this I want to do trading. It will be classified as FVTPL on an instrument by instrument basis, lot by lot basis. There is only one condition. That condition is the choice has to be exercised without undue delay. That means today I will buy the shares. At the end of the year, depending upon how the value fluctuates, I cannot decide, okay, I want to treat it as FVOCI. That is not possible. You will have to decide immediately. That doesn't mean at 10 o'clock I buy, 10:01 you should decide. No, that's also unreasonable. So without undue delay, you have to exercise the choice. And one more condition, once the choice is exercised, it is irrevocable. So after 1 week, you find whatever happens to the share price, you cannot change your decision and say, okay, I want to treat this as FVTPL. That's not possible. So two conditions. One is the choice has to be exercised without undue delay, and once it is exercised, it is irrevocable.
For the year or next year you can change.
No, you cannot change. Prospectively, whatever you buy, you decide. Okay. Now I'll talk about that portion. What are all the consequences of not following this classification principles? What is the effect of not following? I will complete this and I will tell about that, okay, because that's very interesting and you need to know that, okay. Now, as far as the investment in equity securities is concerned, is very simple. So, there's only two choice. There's only two classification possible. One is FVTPL. If it is held for trading purposes, it is FVTPL. If it is not held for trading purposes, you have a choice. It doesn't mean that the minute it is not held for trading, it has to be classified as FU or say no. You have a choice. You can exercise the choice. You can still account for it as FVTPL. That's no problem. But if ever you exercise the choice, choice has to be exercised without undue delay, and it is irrevocable. Now we are left with only one last category, which is investment in the debt security of another company. Now these debt securities, you will be receiving the money back from the company on maturity, right? So there is a maturity period. So it is a 5 years of investment, 5 years of bond, 5-year bond maturing in say 2025. So in 2025 you will get the money back from the company. So there is a category where you can wait till maturity. Previously we used to call it as HTM. I'm sure most of you will be familiar with that, especially doing bank audits. Even today we follow that HTM, right? Right? But this HTM unfortunately is a bad word here. So don't use the word HTM in Ind As 109. The HTM word is not to be used. It's a bad word. Here it is called amortized cost. So you have to, the classification is amortized cost. If you are going to hold it till maturity, so previously the definition used to be as per IAS 39. Okay, I'm not talking about AS at all. Okay, because AS I told you there's no equivalent, and that equivalent is totally out of date. So I'm not even comparing with AS. The previous standard IAS 39. Previously it used to say, if it is held till maturity, you have intention to hold it till maturity and ability to hold it till maturity. So what is intention? Can anybody define what is intention? It is completely subjective. So what you think is my intention may not be that, right? My intention may be totally different, right? So that is completely subjective. The second one is ability. So ability, they used to say, some interpretations used to be, okay, if your share capital is 10 lakhs, okay, and you have made an investment in debt security to the extent of 10 lakhs, you have intention to hold it till maturity. You can say, I have the intention to hold it till maturity, fine, tick, we pass that test. The second one is, do you have the ability to hold? You don't have the ability, because where will you go for your other expenses? Your share capital itself is 10 lakhs and you have put the entire 10 lakhs in some investments which you are going to hold it till maturity, which is 5 years from now. So where will you go for? Again, that logic is not correct, because we can borrow for a day-to-day expenses, right? You understand what I'm saying? So that means you can't define, or you can't say what your intention is and what your ability is. So both are completely subjective. So now we have done away with that. Now the classification criteria is completely objective. So in what way it has become objective? Now there are two tests that we have to perform. The first test is what is called as SPPI test. It is called as solely payment of principal and interest. So the first test is, you need to find out the characteristics of the contractual cash flows that arise from an investment in financial asset. Now every financial asset, what is the objective of investing in a financial asset? There is going to be some stream of cash flows ultimately, right? So the stream of cash flows, if there is no cash flows, there is no investment. Right? You are expecting some cash flows to come. So the cash flows come either in the form of interest or in the form of principal. This is the only two ways. Right? So you need to examine the contractual cash flow, the characteristics of the contractual cash flows arising on account of every financial asset. If it is solely payment of principal and interest, then the first test passes. That means you can say, or it qualifies for being classified as amortized cost asset. It qualifies for being classified as amortized cost asset. So the first condition is solely payment of principal and interest. Now what is this interest? Interest is a consideration, predominantly is a consideration for time value of money. It can also include some benefit towards liquidity risk and a credit risk undertaken by the entity. There is a liquidity risk, there is a credit risk. So it's consideration for liquidity and credit risk. It can also include consideration for some administrative cost and for some profit margin. So these are all the components of interest. Let me repeat again. Interest, predominantly the consideration for time value of money. That is the main thing. Consideration for time value of money. Then it can also include some compensation towards the liquidity risk and the credit risk undertaken by the entity. Right? Whenever you make an investment, there is a credit risk, there is a liquidity risk. And it can also include some administrative cost and a little bit of profit margin. So these are all the four components of interest. If what you receive as a consideration is anything other than these four, then it is not solely payment of interest. It is something else. Like for example, I will give an example. You are making an investment and the terms tell you that if Nifty stays above 12,000, Nifty index, stock market index Nifty, stays above 12,000, the other person will pay you interest at the rate of 15% per annum. If it is less than 12,000, he will pay you only 10% interest. Now here, this is not a consideration for time value of money, even though the quantum of money is reckoned by the number 10% or 15%, it is not a consideration per se for the time value of money. Do you understand the difference? So just because it is 10% or 15%, don't come to the conclusion that it is a consideration for time value of money. It is the primary consideration is not the consideration for time value of money, but instead it is something else on the performance of something which has got no relevance to the time value of money. Or you can even say, okay, I will lend you 1 crore, provided, and you have to pay interest at the rate of 15%. If your profit is 20%, if the profit is less than 20%, then you need to pay me 25% interest because it becomes more risky. You can say like that, right? Something like that. So it is again not a consideration for time value of money. So if this first test fails, then that instrument will have to be classified as FVTPL, fair value through profit and loss account. If the first test fails, it has to be treated as it has to be classified as FVTPL. Then this first test is common for everyone, which means if you are talking about a particular investment, if the first test passes, it passes for everyone. It passes for you, it passes for me, because we are performing this test at the instrument level. Whether you hold it or I hold it, it is the same, because that is what the characteristics of the contractual cash flows arising from this financial asset. You understand? So it is not different from different person. Then the second test is, what is the business model objective of holding the financial asset? you need to examine what is the business model objective. Is the business model objective solely to collect contractual cash flows? Then the second test also passes, and that instrument can be classified as amortized cost instrument. Let me repeat. If the business model objective of holding this financial asset is to collect contractual cash flows only, then the second test also passes, and this instrument can be classified as amortized cost instrument, amortized cost. If the business model objective is to collect contractual cash flows and also to sell, but only once, then it will be classified as FVOCI instrument. That means the fair value changes of that will have to be recognized in other comprehensive income. The fair value changes of such instrument will have to be recognized in other comprehensive income only. Then the business model objective is to collect contractual cash flows and also to keep buying and selling the same instrument. Then it will be classified as FVTPL, which will be classified as fair value through P&L. Okay. Now let me summarize this once again. As far as investment in debt securities are concerned, there are three classifications possible. One is amortized cost, the other one is FVOCI, the third one is FVTPL. FVTPL is a residual class here. If it is not amortized cost, if it is not FVOCI, then it has to be treated as FVTPL. Okay. Now, if there are two tests that are to be performed, one is performed at the instrument level, the other one will have to be performed at the entity level, which is the investor. So the first test that has to be performed at the instrument level is what is called as SPPI test, or solely payment of principal and interest. The contractual cash flows arising from the financial asset should represent solely payment of principal and interest. If this test fails, then this instrument will have to be classified as FVTPL. If it passes, then it qualifies for being recognized or being classified as either amortized cost or as FVOCI. Now this passes, then the second test is to be performed at the entity level. So what is the business model objective of holding such an instrument? Is it to collect only contractual cash flows? If it is to collect only contractual cash flows, then it will be treated as amortized cost. If it is to collect the contractual cash flows and also to sell, but only once, then it will be treated as FVOCI. If it is to collect contractual cash flows and also to keep buying and selling, then it will be classified as FVTPL.
Example.
I will give a lot of examples. We are going to discuss in great detail. Now I have told the principle. Now I am going to ask questions. Now, is there any doubts on this? Please ask. Yeah.
Can this be broken into instrument wise?
Sorry?
Bond wise?
Huh?
Can this be broken into bond wise?
Yes. Okay. Now this business model objective. We'll talk about that. That's your question. The business model objective test will have to be performed not at an instrument by instrument level. So does it mean it has to be performed at the entity level? No, it is not to be performed at the entity level. It has to be performed at a much lower level, which is at a portfolio level or a sub-portfolio level, which means an entity can have multiple portfolios. One portfolio which can be, no, we are not talking about equity, only debt securities itself. One portfolio can be to collect contractual cash flows, which means it can be amortized cost. Another portfolio can be to collect contractual cash flows and also to sell ones, which is FVOCI, and the third one can be to buy and sell, which means it will be FETP. So all the three are possible. In fact, the same security can be in all the three. Any other doubts on this?
How it should be disclosed?
Disclosure is fairly straightforward. Okay, we will. That's covered under 109, 107. Okay, so we have a lot to cover. So I'm deferring the question. Sorry. Okay, I mean it's pretty straightforward. 107 gives a checklist. It's nothing. There's no great challenge there. Okay, I'll tell you certain things which are not in the textbook. That's my objective. Okay. Now any doubts on this? Please ask me. No, otherwise I'm going to ask you questions now. Okay, now I will give you a practical example of this one. Okay, there is one provision here. Okay, if it is investment in equity security, see this is where I find it handicapped because I have to write certain things.
You keep that side just behind you,
Hmm?
Move, look.
Okay.
You look at it, there, that side itself.
Now I'll try to explain orally. If you are not able to make it, then I will write and show. Okay. Definitely, I need this for some other thing. Now I will defer that. Let us wait for someone to come. Now, let us assume there is an investment made in equity security. Okay. You bought a security at 100 rupees today in the first year. At the end of the first year, and you have exercised the choice that you want to classify it as FEOCI. That is the assumption that I am making. Okay. Now, at the end of the first year, the fair value of these shares is 110 rupees. So this 10 rupees is taken to where? OCI. And the equity instruments will be shown in the balance sheet at 110 rupees. Right? No doubt about it, right? Okay. Now at the end of second year, the same shares 125 rupees. So another 15 rupees is taken to the OCI. No doubts about it. Okay. Now in the balance sheet will be shown as 125. And in the third year, this security is liquidated. You are selling this at 135 rupees. Just call him. This security is sold at 135 rupees. Okay. Now tell me, this 10 rupees. Now the profit is 10 rupees on the particular third year, right? When it is sold, this 10 rupees will be taken to OCI or P&L, or the entire 35 rupees will be taken to OCI or P&L. 10 rupees is taken to P&L. 25 rupees will remain in OCI. 25 rupees will also be taken to P&L. Huh? 25 rupees will remain in OCI. Only 10 rupees will go to P&L. So entire 35 will remain in OCI. It won't go to P&L. Okay, I'll just write it. Are you able to see this? At the end of second year, okay. So 15, and at the end of third year, 135. Is this what you are saying? Okay. Okay. Now this is for equity. Okay. Okay. Now the answer is correct. It will remain in OCI. Okay. Now this is debt security. Now what will happen? Is this the same or anything different?
Read to maturity.
Huh?
Up to maturity, on maturity only, no?
No. We are not even there. Maturity is somewhere.
Okay.
It is
Sold only once.
yeah, because it is FUOCI. No? This is classified as FUOCI. See, same classification FUOCI is a debt security. So, okay. Now I will tell you the answer, but you have to tell me why it is so. So this will be transferred. This 35 rupees will be transferred here to P&L if it is a debt security. So if it is so if it is an equity, so loud suddenly. If it is equity, okay, then it will remain in OCI. If it is a debt security, then it will be at the time when it is liquidated, it will be transferred to P&L. Now, if you have understood the classification criteria which I explained to you, you should be able to answer why it is like this. Now, this is the question. Okay, I am posing you.
Because in equity, you have chosen to take the OCI route.
Sorry.
In the equity route, you have chosen the option of an OCI to protect the P&L. So you can't again vitiate the P&L by transferring the at the year end.
The income is guaranteed.
So you have to buy
No,
and sell.
he told the answer first itself. Very excellent. By any chance, did you attend my previous session? No. Yeah, you attended.
I was in your class for the Ind As.
Okay, good. So that is the answer. Okay, we will elaborate a little bit more on this. Okay, so this is because unfortunately, Okay, now tell me the other one. I will explain what he said. I will explain. Is there any other answer? You want to try something else? Yeah.
SPPI test fails.
No, then you are talking about debt security now.
Yeah.
Okay. Yeah, tell me. Yeah.
And hence it gets transferred as.
No. If the SPPI test fails, it becomes FETPL straight away. So there is no question of FUOCI at all.
Yeah, which is fine. That is why it goes into P&L.
No. We are talking about a classification as FEOCI, which means the SPPI test passes. If nobody is going to answer, I will let him answer. Any other answer? Okay, now you can answer.
Because that classification is no more relevant and without being trading in it, so it should likely be.
No. We are not trading. We are selling only once. There is no trading. Any answer? Huh? Yeah? No. We are not there. It's FUOCA. There is no amortized cost here. This is already classified as FUOCA, which means it is the SPPI test is passed. Okay, and the FUOCI classification is done already because I'm only asking about the treatment. Huh?
The investment is no longer there.
Sorry, sir?
The investment is no longer there.
Yes.
That is why you are transferring to P&L.
Okay, so in the case of equity also it is that should be the same answer, no? Because there also the investment is no longer there. Why are we saying it should be retained in OCA then? He has already given the answer. Okay. Now let me. I'll explain to you. In the interest of time, I'll explain this to you. Normally, I let you speak so that we can discuss so many other combinations that will become better. But in the interest of time, I'm cutting it short. Okay. Now tell me, what is the basis for classifying an investment in equity security into FVOCI? Why would somebody classify an investment into FVOCI? Huh?
You hold to collect cash flows as well as
No. We are talking about equity. Equity. I never said the cash flows at all, right? So
not trading. It's held as investment, not held as trading.
it is not held. It is not held as trading. It is not held for trading purposes. Yeah, it is not held for trading purposes. No. See, okay. Now, let me put it differently. Okay, it is not only if it is not held for trading purposes. You have the choice to classify it as FVOCI. You can still classify it as FVTPL also, right? If it is not held for trading purposes, you still have the choice. But why would you exercise that choice and classify it as FVOCI? That's my question.
To insulate your P&L.
Yeah, that's what I'm expecting from them. Yeah, you already told the answer. So basically, the reason is you don't want any fluctuations in the P&L, right? Why would you opt for this? Why is the choice that is given? Why is the choice that is given to the investor? The investor would not want his P&L to be vitiated by the fluctuations in the fair value on a periodical basis, on a quarterly, yearly, whatever the basis. It doesn't want. So in order to insulate, the entity can exercise the choice. So who is exercising the choice? The entity is exercising the choice. So it would be completely ridiculous to say, or it will defeat its own purpose to say that so long as you hold the security, your P&L is protected. That means you can retain in OCI, but the minute you sell it, you liquidate it, it has to come back to the P&L. What is the purpose? Understand the point? So it is completely meaningless if you say that this also should have to be taken back to the P&L. It's completely meaningless. The whole exercising the choice of showing it as classifying it as FVOCI becomes completely meaningless. Do you get my point or not? Right? So even after liquidation, there is no necessity that it should not be transferred to the P&L. It has to remain in OCI. Because once it comes to the P&L, what happens? It becomes your EPS undergoes a change, right? So it has its own plus and minuses. Do you understand this point? Okay. Now this is not the same answer why we are classifying, why we are plowing back the OCI into P&L for a debt security. That answer I have not yet received so far. Now let us examine this, because see, I want to dwell deep on this one, because this gives you a clear understanding as to the principles behind the classification itself. Okay, if you understand this, then you know for sure what is the logic behind this. Because I have been repeatedly telling you that the basis for this classification, I'll give you a chance 1 second. The basis for this classification is completely objective. It is not subjective. So that is the whole point I am trying to. Yes, please.
In case of equity, it is a choice between FOC
Yes.
and
Yes.
in case of debt, it is not a choice.
Perfect. That's one of the answers. Yes. Perfectly correct. That is only part of the answer. But what is the real answer? Yes. So in the case of debt security, you don't have a choice. It is by applying a set of criteria that is prescribed in the standard, you decide whether it has to be classified as FVOCI or as FVTPL or as amortized cost, right? It is not a choice that is given, unlike investment in equity securities. Okay, that is only one answer. That is only part of the answer. What the other part of the answer is that there are two tests are there. The first test is passed. That means SPPA test is passed. The second test is business model objective, where you are holding these investments to collect contractual cash flows and also to sell once. So that means you may not sell. You may, in all probability, you may sell it. You may not even sell. You may hold it till maturity. If the opportunity is right, if the market price is right, you can sell once, right? So you are still holding the choice. Okay. Now, since you may sell tomorrow. You are preparing the balance sheet as on 31st of March. You may sell on 1st of April, possible, right? You can sell any day. You can sell on 1st of April also. You have not sold on 31st March. That is why it is still appearing. You may sell on 1st April. But when you sell on 1st April, the stakeholders should know what is the value that you will be realizing if you are selling it tomorrow. That means you should know what is the fair value of that as on that date. So that is the reason why it is measured at fair value. So in the balance sheet there are two aspects to it, right? You have the balance sheet, you have the P&L. So in the balance sheet you are showing it at fair value, but in the P&L you are not showing. Why? Because you have not sold yet. Nevertheless, the increase in the value, let us assume there is an increase or decrease, whatever it is, that belongs to the shareholders. It has to be reflected in the shareholders' net wealth. So the way to reflect that is to show it in the other comprehensive income, because other comprehensive income is part and parcel of your reserves. So it goes directly to the reserves, it doesn't go through the P&L. But on the day when you have sold, that event has already happened. It has crystallized. You have exercised the choice, which means what? You can sell only once. That has already happened. That means you have already booked your profit. So it has to be shown as profit. There is no point in retaining again here as part of the shareholders' wealth. It is nevertheless, it is part of shareholders' wealth, but it comes right royally through the profit and loss account route. Is it clear? Let me explain to you once again. Listen very carefully, because this is very, very important. This also explains the rationale behind why this classification. Okay. FVOCI classification criteria is based on two things. One is SPPA test has to be fulfilled. That means the consideration what you receive is relating to interest. That's all. Okay. It is not anything other than interest. If it is anything other than interest, it has to be fair valued. You have to take it to the P&L. So it is relating to interest. Then the business model objective is to collect contractual cash flows and also to sell once. We don't know when you are going to sell. You may sell tomorrow, you may sell today, you may hold it till maturity. Just because you are classified as FEOC doesn't mean that you cannot hold it till maturity. You can still hold it till maturity, right? But you can also sell once. But since you have the right to sell once, the stakeholders or the shareholders should know what is the value if it is sold today. So at the end of the balance sheet date, you should know what is my fair value. But the event has not happened. That means the profit or loss on that sale has not yet been crystallized. It is part of shareholders' wealth. It is not yet crystallized. So how do you account for it? It has to go to the shareholders' wealth without affecting the P&L. So the only way to do is to keep it in OCI. So, but when the event occurs, when the liquidation occurs, that means on this date, in the third year, the liquidation happens, the event is crystallized, you can sell once, that has already happened. Because it has happened, it has to be shown in the P&L. So not merely the 10 rupees will be shown in the P&L, but the entire 35 rupees will be shown in the accumulated OCI will move to the P&L. Is the answer clear to you? Okay.
same logic apply for equity?
No.
Equity.
No, equity is different. So equity, the reason why it remains in OCI is the answers to these two questions are not the same. Both are different. The answers are different. In the case of equity, the logic behind having FEOCI classification is to ensure that your P&L is not affected because of fluctuations.
If it's an investment company, what will? Main objective
Then,
is to earn income from
yeah.
sale of.
No, that means it is it's a trading, no? Then it is different. Then it will be only P&L. Then it is P&L. We are talking about that. We are not talking about that. Then it becomes purely. Is the answer clear to you? Okay. If this is clear to you, then it means you have understood the classification criteria, because the classification criteria is so meticulously drafted. There is no subjectivity at all. Do you find any subjectivity here? Absolutely no. Right? Okay.
So just to reverse this, instead of 125, third year it becomes 118.
Whatever it is. That loss, entire, whatever is the cumulative profit or loss will be taken to the of course. Okay. Now we will see some of the slides.
Where the convertible debentures are down the form, convertible debentures if it is there.
Yeah.
Which I invest.
See, convertible debentures, there are two components. One is the equity portion is there. There is also a debt portion is there. So now there is no requirement that you have to bifurcate. If it is an asset, if it is a liability, then you have to bifurcate. Now there is an asset, you don't have to. It can be you can just take the fair value of that and account for it as that. Okay. Now, so here you will see that at the end I have given the classification criteria. The classification criteria for FEOCI equity instrument is exercising the option. You are exercising the choice. In the case of FETP, it is residual. FEOCI and amortized cost in the case of debt instrument is by applying the objective criteria. By applying a set of objective criteria is what you do that, right? So there is no choice there, but if it follows in that particular stream, then you have to account for it like that. I'm sure all the slides are given to you, right? Or the PowerPoint is given to you? No? PPT. Yeah, PPT in the form of PDF it's given. They will be sending it to you. It's already there. Okay. Now, you want me to walk through this or it's clear? Okay. If you want me to. So all these things are there. I'm not going to run through the whole thing again. See here in the case of whatever I have mentioned in the red, you can see that. So FEOCI equity instrument, there is no reclassification of gains to P&L on derecognition, whereas in the case of debt securities, it is reclassified. OCI is plowed back to the P&L. Okay. Now this amortized cost. Now let us talk a little bit about the amortized cost category. I'm showing this so that you can see me. Otherwise, we'll be seeing the other slide. See, the amortized cost category, right, is I'm going to answer the first question what you asked. You asked some question, I said I will play later, no? What is the consequences of not following? Consequences, that's the question you asked.
Sure.
You asked that.
I lost track. Okay. Well,
Now,
it's clear, all that is clear.
Okay, now the amortized cost category is a very coveted class. Why? Because you are not required to do any fair valuation of that, right? So you don't have to worry about the fair value of that. You only have to account for the interest based on the effective interest rate. So there will be a lot of tendency on the part of the investor to classify this as amortized cost as far as possible, right? So previously in one IAS 39, okay, if ever you classify something as amortized cost, there it used to be called as HTM. I said don't use that word HTM. So if it is classified as HTM and then you sell, you're not supposed to sell, but if you sell, there is a strict punishment that is given. So it is like the teacher, if you make a mistake previously when I was young, so the teacher used to take the foot ruler and then, so before giving, the teacher will say, show your knuckles. Why? It will pain more. So you will show like this, the teacher will say, show like this so that it will pain more. So as per IAS 39, if you sell something that is classified as HTM, the punishment is very simple. The punishment is you have to classify everything else under that HTM category, you have to move it to FETPL. So you made a mistake, only one, the remaining thing, everything will have to be moved to FETPL. So it's a very dangerous punishment, right? Because you will have to do the fair valuation of the entire portfolio, which otherwise qualifies as HTM or amortized cost. You understand? But then that is showing, it is not showing the knuckles. So showing the knuckles, it has to pay more. So the treatment used to be, you cannot classify anything as HTM for the next 2 years. For the next 2 years, you cannot have the classification called HTM in your books. So that used to be the strict regime before this IFRS 9 came into being. So now with this one, or Ind As 109, you can all be very relieved. So there is no such stringent provision. It is all only prospective. Supposing you do something, see the standards, the accounting standard doesn't tell you how to run your business. It is your prerogative. If you want to sell something which you are classified as amortized cost, jolly well you can do that. But only thing is, don't prospectively it will impact. So whatever has already done, so next time when you do the classification, don't do like that, because you know what is going to be your business model objective and whether you will be selling or not selling, you know all that, and accordingly take a decision and then do the classification prospectively. So it is a lot simpler now. It's a lot less stringent now. That was your question first you asked. So what if I sell something which is right? Okay. Now the okay, we will walk through this. I think I have already explained to you. I'm not going to spend much time. Principal and interest. Okay, so what is principal? What is interest? Interest, I told you there are 4 categories: consideration for liquidity risk, credit risk, etc. Profit margin, administration cost, but predominantly consideration for time value of money. I have explained all this to you. Now this business model assessment is not dependent on the management intention and ability. So that is dispensed with. So it is not instrument by instrument, it is at a higher level. It doesn't mean it is at an entity level, it is at a portfolio or sub-portfolio. Okay. And you can have more than one business model. Now you can have multiple models, so all those things are there. Now there is a very, very, very interesting see the exceptions, whenever you sell an asset, right, the exceptions, the financial asset no longer meets the entity's investment policy, the insurer adjusts the investment portfolio to reflect a change, the entity needs to fund capital expenditure, or supposing the credit risk increases beyond a point, you can sell, right? So there are some exceptions to this thing. Now I want to show you one thing here. Okay. So entity has a portfolio of financial assets classified as amortized cost. A change in the regulatory treatment of these assets has caused the entity to significantly rebalance its portfolio in a particular period. The entity need not change its assessment of business model, as the selling activity is considered as an isolated one. There's a beautiful example that is given here. The continuation of the same thing is that by contrast, okay, supposing the bank, just put it as company because now this is not applicable for banks. So this is the company is required by its regulator to routinely sell the financial assets from a portfolio to demonstrate that the assets were liquid. So that means it has to do periodically, it has to sell a part of that. Then you cannot classify this as amortized cost asset. It has to be classified as FVOCI only, or I'm sorry, FETPL only, right? Is it clear? So if you have to keep churning that to show prove that the assets are liquid, then it cannot be classified like that. Okay. So I think I gave this example also, this effective interest rate, how this effective interest rate is to be computed. Now this effective interest rate, I told you, is something that is laid in stone, because once it is computed, it is not recomputed at any point of time for the rest of the life of the asset. There is only one exception to this rule. There is only one exception. I will tell a little while later what this exception is. Okay. Now let us come to the next interesting, very interesting topic. Now the classification of assets is over. Financial assets is over. Any doubts on classification of financial assets? No. Now we will go to classification of financial liabilities. Most interesting portion. Now you will see. Okay. So
EAR and ECL is covered by some other.
ECL. I will do it. Expected credit loss. Yeah, of course. Huh?
EAR?
Yeah, EAR.
That is okay.
There is the thing. It's just okay. Now this financial liabilities, classification of financial liabilities, I told you, is very interesting. The reason why it is so interesting is because all the liabilities are classified as amortized cost only. So there is only one classification called amortized cost. If it is not a derivative instrument. If it is a derivative instrument, financial liability which is a derivative instrument, then it will be classified as FETPL, because even if it is right, all the profits and gains on derivative instruments will have to be taken to the P&L, irrespective of whether it is a financial asset or a financial liability. Okay. Now let us see some examples, live cases here. Okay. Are you able to see?
Yes.
2025. Bonds. 2025, 8% bonds, rupees 100 crores issued by the entity. Okay. Now, how did you get this 8%? You got this 8% because the benchmark rate or the risk-free rate, say 6%, and the credit risk so 8%. Okay. Now, at the end of year 1, so this is 2020 Jan, let us assume 1st of Jan. Okay. Then December 2020 is your, let us assume is your financial year, okay, accounting year. The benchmark rate becomes 5%. So at the end of 1 year, this is 5%, and your credit risk is 2%. The interest rate becomes 7%. Okay. So when if the interest rate goes down, the value of the liability goes up, right? Is it clear? Are you with me? Because it gets discounted at a lesser rate, so the value will go up, right? So let us assume that this 100 crores becomes 103 crores, right? So at the end of the first year, in the balance sheet you will show this liability at what rate? At how much value? I told you already the answer, no? So if the interest rate goes down, the value of the liability goes up. And I also told you, I also told you that it has gone up by 3 crores, 103 crores. So it will be shown in the balance sheet at what rate? It will 103 crores?
Yes.
103 crores? So you will keep changing the balance sheet every year when the interest rate goes up? How many of you do that?
Revaluation.
You get my point? So every year there is some change in the RBI announces interest rate changes, no, every year. So you go and keep changing the value of your liabilities? Okay, first then let me ask you this question. What is the classification of this liability? What it is classified as what? Amortized cost. So amortized cost, today the liability is 100 crores. 5 years down the line you will have to repay how much? Same 100 crores. So what is the amortized cost? The amortized cost continues to be 100 crores every year. See, in the first example we said the investment was 85 rupees. You are going to get 100 rupees. So there is a 15 rupees gap. That 15 rupees will be converted into effective interest rate. So it becomes 6%, becomes 11%. So here there is a 100 crore liability today. There is a 100 crore liability after 5 years. So every year it will be how much? Every year it will be 100 crores only. So why did you say it is 103 crores? Because I told her. I said what is the fair value? I never said, I only asked you what will be the fair value. The fair value of course is 103 crores, but it doesn't mean that you have to account it at 103 crores. Right? It will be accounted at 100 crores only. Okay, we'll have tea and then continue this. So this 103 crores is the value, but it doesn't mean that we will be showing it at 103 crores, right? So that is a fair value. Now, let us assume that this entity has taken an interest rate swap by which they have converted this fixed rate debt exposure into a floating rate debt exposure. Okay, like so you receive 8% and you pay float. So this interest rate derivative has got this, it is an interest rate swap. It is an interest rate swap. Interest rate swap has two legs. One is the pay leg, the other one is the receive leg. So here you have an exposure to pay, because you are, it's a liability, you have an exposure to pay a fixed rate of 8%, right? So irrespective of whatever happens to the interest rate, you will have to keep paying at 8% year on year. But then your corporate economist told you that the interest rate is going to go down. Eventually over the next 5 years interest rates are going to fall, and so you decided to convert this fixed rate exposure into a floating rate exposure by getting into an interest rate swap. So you receive the same money what you pay, so you are paying 8%, so you receive 8%, so that gets knocked off, and then you pay float. So if the interest rate moves as per what you think, or what as per what the corporate economist thinks, then the company will be benefited, right? Because it will have to keep paying lesser and lesser over the period of time. So now let us assume that it did fall. Like for example here, the interest rate was 6%, the benchmark rate was 6%, and at the end of the year it became 5%. So effectively you will have to pay 5 plus 2, 7%. You will receive 8%, you will pay 7%, correct? And this you will have to keep doing for the next 5 years, because this is another 5-year maturity is there. So what will be the value of the derivative? You will keep receiving 8% and you will keep paying only 7%. So today that's what you know, right? So you will keep paying at 7%. So the fair value of this derivative interest rate swap will be positive or negative? It will be positive. It will be an asset, right? Because you will have to receive more in future and you will have to pay only less. Your liability is less, your asset is more. So obviously the net value will be your asset. Now let us, and I also told you the ballpark number, which is 3 crores. So the value of this asset will be 3 crores, right? Roughly it will be 3 crores. Any doubt on this one? Okay, now there is no doubt about the number 3 crores, right? The 3 crores is arrived at because you will receive at 8%, you will pay only 7%, the net effect on the next 5 years will be so much, right? So this 3 crores you have taken an interest rate swap basically to hedge your exposure in fixed rate, okay, your exposure in fixed rate, you are converting this fixed rate exposure into a floating rate exposure, that's what you are doing, right? So you have a derivative net asset of 3 crores at the end of the year. So you pass an entry debiting the interest rate derivative as an asset and crediting profit and loss account, which is your MTM changes on the derivative, right? So your P&L shows profit. Your P&L shows a profit of 3 crores at the end of the year, correct? And as far as this exposure is concerned, this liability of 100 crores is concerned, what is the profit or loss that you will be taking to the P&L at the end of the year? Zero. Because we are not going to account it at 103. We are going to account it at 100 crores only. Right? Why? Because this is an amortized cost liability. Amortized cost liability, there is no question of the same 100 crores will be there, so though you don't pass any entry. So there is nothing that comes to the P&L from the fixed exposure side, from the liability side. Is it clear? But from the derivative which you have taken, what is the purpose of this derivative? The purpose of this derivative is very simple. You are converting the fixed rate exposure to a floating rate exposure. Correct? Is it clear what we are doing with this derivative? We are only converting. So, net, if you take both these instruments put together, this is going to result in a P&L fluctuations year after year. Right? At the end of the year, you will have a problem. So this is what is called as an accounting mismatch. There is an accounting mismatch. Why? Because you have two instruments. These two instruments, the basis of classification of these two instruments are different. one instrument is taken to hedge the other instrument. The basis for these two instruments are different. One is classified as amortized cost, the other is classified as FVTPL. Because of this, there is an accounting mismatch. So you understand what is an accounting mismatch? An accounting mismatch arises when there are two instruments and the two instruments are related to each other in some form. One instrument is treated or accounted or classified as amortized cost, the other instrument is classified as FVTPL, so there is an accounting mismatch. If there is an accounting mismatch, the entity is given a choice. You can exercise a choice, and that choice is called as fair value option. You can exercise that fair value option and you can say, okay, I want to value my liability also at fair value. Normally, the liability is valued at what? It is classified at amortized cost. But if there is an accounting mismatch, only if there is an accounting mismatch, you are given a choice, you are given an option to value this on a fair value basis. That means you can exercise FVO. So please do not confuse this FVOCI. FVOCI is for assets, financial assets only. Here it is FVO option, fair value option. So when you go for fair value option, now this liability will be accounted at 103 crores because the fair value of this is 103 crores. Is it clear? Normally the amortized cost value is 100 crores, but the fair value is 100 crores. So you will be accounting for this at 103 crores. So that means, so when the liability goes up, the profit comes down, right? So this will be booked as a loss. So the entry that you will be passing is debit the loss and credit the liability. 3 crores liability will be credited, right? So this will be so your P&L problem solved. Are you with me? Okay. Now this fair value option is somewhat tricky. It's not as innocent as you think it is. Okay. The reason is because you have to exercise this option without undue delay, first condition. The second condition is this option is irrevocable. Okay. Now let us assume, for whatever may be the reason, the Treasury Department liquidates this interest rate swap. The interest rate swap is unwound, it is liquidated. Then in the next year, now let us assume that the interest rate becomes 6%. The interest rate goes down, the value of the liability goes up. Let us assume that the value of the liability goes up from 103 crores to 105 crores. So extra 2 crores. Extra 2 crores is a loss. Now what is the profit coming from the interest rate swap? 0. Why? Because it's already been sold. It has been liquidated by the Treasury Department. But can you change this method of accounting back to amortized cost? No, because it is irrevocable. So here you will continue to have problems in your P&L till 2025 on account of the fixed rate exposure because you have selected this fair value option. So here this remedy is worse than the disease. So it is very difficult, you have to be very careful in order to exercise this option. Is it clear? Okay, now I'll tell you another interesting aspect of this one. Now, in one company, okay, let us assume the company had this accounting mismatch, as a result of which they decided to adopt this, exercise this fair value option, right? And then the Treasury Department sold the interest rate. Exactly what we discussed happened. But then, at the end of the year, what happened was, the interest rate remained at 6% at the end of the year. The credit risk increased. The credit risk increased from 2%, it increased to 3%. From 2%, it became 3%. Now, if the interest rate goes up, the value of the liability comes down. And we are accounting it for at fair value basis only. Fair value option we have already exercised. There is no question of going back, because once exercised it is irrevocable. So the value has become 97 crores. Okay, let us assume. So this results in a profit of 3 crores to the company, correct? Because the liability has come down, so the profit is 3 crores. Now the CFO and the CEO realized that they are making a profit of 3 crores because the credit risk increases by 1%. Is it correct or not? It's correct, no? The credit risk, your benchmark, RBI has not changed the interest rate at all. The credit risk has gone up. And because of that, the company has made a profit of 3 crores. Now the CFO and CEO, they join together, they think, okay, this looks like a very brilliant idea. So what we will do is, we will come only half a day to the office. Half a day we will go to the club. We will play 3 cards. So we will make this company more risky. The company, everybody knows the CEO is only half day is going, half day he is. So the credit risk at the end of the third year, the credit risk became 5%. So the fair value of this one became 80. So the company made another 12 crores profit. So the CFO and CEO decided, okay, why should we come to the office at all? We will, every day, we won't even come to the office, because half a day we don't come, we make 12 crores profit. We don't come the full day, we'll make more profit. So they stopped coming to the office altogether, and the credit risk became they made another 15 crores profit. So how many of you are getting good ideas from now? Is it right, or is there anything wrong? Huh?
Fundamentally wrong.
Why? Because you should not go to the club. Is it that way?
It's hypothetical. It's only
No, it's not. No, not hypothetical. Why? It's not hypothetical. It's real. I mean, credit risk goes up because of so many reasons.
Because of their absence.
Maybe, because the CEO doesn't come, what happens here? The CEO doesn't come to the office, and instead of focusing on the business, he focuses on something else. What happens to the credit risk? How will the market perceive the credit risk? It will be obvious in the results also, right? Okay. Is there anything wrong in this? Am I talking sense or something? Am I blabbering?
So on redemption, you need to take a hit at somewhere. This goes on.
2025, long term, yeah. We are all dead. In the long term, we are all dead. Who bothers about long term? Today, how am I? I don't care about what happens in the long term. Is there anything wrong?
The objective is missing.
Objective. What is the objective?
It was not intentional.
No, initially it was not intentional, but then they found out, yes.
So that means it is not a firm profit.
Huh?
It's not a firm profit.
It's only notional.
It's only notional.
You can't, I mean, it's notional, whatever you show in the books, how it is said is notional. It is shown in the books, no, you pass an entry. What do you mean by notional? You pass an entry. You pass an accounting entry for that, correct?
Unrealized.
Whatever it is. You pass an accounting entry. Your books of account is showing a profit or not? Is there any two ways about it? No. Right? Okay. So, now this is perfectly correct. There is nothing wrong about this one. But there is only one small change. Now this was the situation before, immediately after the financial crisis that was plugged in 2013. Now, any change in the fair value of the liability on account of its own credit risk, the entity's own credit risk, is to be shown in the other comprehensive income and not to be recognized in the P&L. Only fair value changes on account of the market rate risk. So the market rate is the same, right? 6% is the same. Anything relating to the market rate risk alone can be taken to the P&L. In other words, all through these differences should be shown only in the other comprehensive income, and this is one of the cases where once it is transferred to the P&L or transferred to the OCI, it never ever comes back to the P&L. It stays in the OCI forever. Okay. So there is an easy way by which you can find out what is the fair value changes arising on account of the benchmark rate or the market rate, and what is the fair value changes arising on account of the entity's own credit risk. Okay, it can be easily found out, and you have to account for it separately. Clear? Okay. So we'll go through these slides. It will give an opportunity for you to read it once again. So all liabilities are to be shown at amortized cost normally, right? But held for trading, including derivatives, is at FVTPL and designated at FVTPL on initial recognition. Now, fair value option for liabilities. The accounting treatment is fair value changes due to credit risk is taken to other comprehensive income. Fair value changes not due to credit risk is taken to the P&L. Okay. Then presentation. Amounts presented in OCI is never reclassified to the P&L. Okay. Now you can, if you're able to see this one, you can have a look at this one. So the accounting treatment for amortized cost category, nothing happens to the fair value. Okay, because I mean whatever happens to the fair value, it is not recognized because it is stated as amortized cost, and the P&L, nothing is taken to the P&L in spite of the fact that there are movements in both the movements in the benchmark rate. Okay, even if there is a movement in the benchmark rate and even if there is a movement in the own credit risk, nothing ever happens because it is to be treated as valued at amortized cost. Only if it is valued at fair value, then the question comes how it should be treated. So FVO category is applicable only if there is an accounting mismatch and you opt for this fair value option, and once you opted for the fair value option, it is not revocable. So it is irrevocable, that is the point. Now here the fair value changes. So the amortized cost continues to be the same, but since you are accounting at fair value, the fair value changes are taken to the P&L. So here there is no change in the credit risk. Everything is on account of the benchmark rate, so everything is taken to the P&L. Right? So the same thing what happened during the financial crisis, even though now you find that there is changes on account of the credit risk is also there. So there are some changes on account of benchmark rate, but still the composite rate is what mattered at that point of time. So the composite rate went up, and when the composite rate went up, it resulted in the reduction in the fair value of the liability, which was shown in the P&L. That was the big risk. So it is not, it's never reclassified to the P&L. So now the treatment is, now you can see the two rates distinctly. One is the benchmark rate, the other is the credit risk. So the credit risk goes up, the benchmark rate also fluctuates. So fair value changes on account of the benchmark rate or other than the own credit risk is taken to the P&L, while changes on account of the own credit risk is taken to the other comprehensive income. So now there are bifurcations. So you can see that even though the total fair value changes in the first year is 3 crores, 1.4 crores is on account of the fair value changes other than credit risk, and only 1.6 is on account of own credit risk. Okay. So like that it is bifurcated and treated accordingly. So these are instances where OCI should not be reclassified. I think we have seen all of those things today. Gains and losses due to own credit risk should not be reclassified. Gains or losses of investment in equity instruments, I explained to you in great detail. This cannot be reclassified back to the P&L. Then where it should be reclassified is Ind As 21, FX changes, and 109, investment in debt securities, and there is also on account of this cash flow hedge, where it is temporarily parked in the other comprehensive and comes back to the P&L when the hedged item affects the P&L. So those are the. Now let us see about the impairment model. Easier, but easier.
One of the slides you showed held for trading and liabilities. What do you have for
held for trading liability? It is, it is not. It is. I mean, there could be some classification where it is held for trading purposes. Okay. Now, see, this impairment is a very new concept for us. Okay, because the impairment what is referred to in Ind As 109 is expected credit loss. So impairment, not the usual impairment what we already know, but it is something different, because here we need to find out what is the expected credit loss and not what is the incurred credit loss. So we have been all along accounting based on incurred credit loss. So we had this ICL model, incurred credit loss model, but now we have to move to the expected credit loss. See, now this is also one of the market change in the way we account for. Like for example, we always account based on the historical cost. Right? We never do any accounting based on some projected, right, or based on any projections. It is used only for when you come up with an IPO, you do some projections and then say what is my future profitability and so on, but not from an accounting point of view. Accounting point of view, it is always the historical, right? It is never. So this I would say is an exception to that rule, because here you need to find out what would be the expected credit loss based on the historical credit loss experience and also based on certain forward-looking macroeconomic data. Like for example, what would be the impact? Like for example, today you have this coronavirus affecting so many. We don't know what is going to be the impact and so on. But then you may, if you have to prepare an accounts today, you will have to probably take that into account and say how that is going to affect my collectibility, and what would be the impact of the financial instruments on account of this one. You may have to quantify that and then take that as one of the parameters. Okay, how you take it's a different subject altogether. Okay, it is part of the quants. I will explain to some extent whatever we can do as accountants. Okay, but then there are so many mathematical models, statistical models, which gives you how to account for that particular component. But now let us look at the theory behind the whole thing. Okay, to understand this. Now, the expected credit loss, the impairment model, first I told you the impairment model is different in a very subtle way. Okay, there are if you look at the impairment, blow it up. Okay, there are a lot of differences between the US GAAP and IFRS. Okay, IFRS, a lot of small differences are there. Now, this impairment has to be recognized at every accounting period, taking into account the forward-looking macroeconomic data. The objective behind this requirement is that at any point of time, you need to be transparent to the investors, to the stakeholders, as to what would be the impact of non-collectability of your cash flows. So there is a probability that some of your future cash flows may not be collected. So what is the impact of those? So now it is expressed in a particular way. It is expressed as the present value of the cash shortfalls occurring over the entire life of the asset. That is what is called as expected credit loss. Expected credit loss is the present value of the cash shortfalls occurring over the entire life of the asset. Now the cash shortfall is defined as the difference between the contractual cash flows and the expected cash flows, which obviously means that you have to reckon the time period also into account. In other words, you are supposed to receive, let us assume, certain amounts of cash flows in the next 5 years. That is the expected cash flows. And because of the occurrence of the probability, or because of this probability of default occurring, what would be the expected cash flows at the relative or the respective points of time? You need to find out the difference between those two and then discount it back based on the effective interest rate of that particular instrument. Because the effective interest rate, as I told you, will have to be computed for every instrument at the time when you buy an instrument. At the time when the instrument is purchased, you will have to compute the effective interest rate, and based on the effective interest rate, you need to discount the cash shortfalls and then arrive at the probability. Okay. Now, to put it, as far as the expected credit loss is concerned, it is recognized as per IFRS. It is recognized in two stages. Okay. One is called as the 12-month expected credit loss. The other one is the lifetime expected credit loss. Okay. You will have to recognize 12-month credit loss for all type of assets. For all type of financial assets, you will have to recognize 12-month credit loss. That means you are buying, let us assume you are buying an instrument on 27th of Jan 2020. Today you are buying that instrument. Your first accounting period or reporting period is say 31st of March 2020. On 31st March 2020, you will have to find out what is the expected credit loss based on the probability of default occurring over the next 12 months. A rolling period of the next 12 months. What is the probability of default? And if the default were to occur, what would be my cash shortfalls for the entire life of the asset? Like for example, you have given a loan, which is a financial asset for you, for a period of 10 years. Okay, and there is, let us assume that there is a yearly repayment that is to be made. You expect the other person to repay you over a period of next 10 years. Okay, yearly installments. Then you will have to find out if there is a probability of default occurring on this instrument in the next 12 months, how much I would be able to collect in the remaining 9 years. What would be my collection? What would be my expected collections? So you know what is the contractual collections, contractual cash flows, and what is the expected cash flows at the respective time points, which will span over a period of the next 10 years. So find out the cash shortfalls, discount all those cash shortfalls based on the effective interest rate of this particular instrument, and that is your expected credit loss. Is it clear? This is the basic principle. So now there are two things that what I want you to understand here is that the 12-month probability is to be applied on all instruments. There is no distinction on all instruments. Now there is only one impairment model which is applicable for all the financial assets. There is no multiple models for different assets. There is only one model. Then the other one is you need to compute the cash shortfalls occurring over the entire life of the asset, not merely the next 1 year. The probability of default occurring has to be considered only for the next 1 year, but the cash shortfalls has to be considered for the entire life of the asset. If it is a 10-year asset, you have to consider what is the cash shortfall for the entire 10 years and then discount those cash shortfalls. Discount it based on the effective interest rate of each individual asset. Now, if the credit risk goes up significantly from the time you purchase the asset, then you will have to find out what is the probability of default occurring over the entire life of the asset. So obviously, the probability that it will default over the entire life of the asset is much higher than the probability that it will default in the very first year, in the next 12 months, right? Obviously, it will be higher. So you will have to apply this and then find out what is the expected cash shortfalls over the entire life of the asset. Again discounted. So that is called as stage 2. So this is done in 2 stages. Basically, it is done in 2 stages. This is how it is different from the US GAAP. In US GAAP, you will have to always compute the probability of default occurring over the entire life of the asset. There is no 12-month default and life of the default concept there. So there it is only one, which is the probability default occurring over the entire life of the asset. That's one of the basic distinctions or differences between US GAAP and IRAP. I'm not going to delve deep into it, just for your information. So now let us assume that you are buying 2 debt instruments. Okay, one debt instrument has a rating of say A. Another debt instrument has a rating of say C. Okay, today you bought this. On 31st of March, both these instruments are rated C. Okay, the one that you bought with a rating of A has become C, which means there is a significant increase in the credit risk. It has gone down by 2 notches. There is a significant increase in credit risk. So on that particular instrument, you have to find out the probability of default occurring over the entire life of the asset. But on the other instrument where you bought, when you bought it was rated at C, and today also it is rated at C, so there is no increase in credit risk. So you will have to consider the probability of default occurring only over the next 12 months for that. So it is not the absolute credit rating that matters, but the relative credit rating from the time you bought the asset till the date of valuation, right? So that is what is relevant. So if it has gone, if the credit rating has gone up significantly, then you will have to consider the expected credit loss for the entire life of the asset, the probability of default over the entire life of the asset. Is it clear? Okay. Now we will see the third one. Now on these 2 stages, that is stage 1 and stage 2. Stage 1 is applicable for all type of assets. So that means irrespective of whether it is a good asset, standard asset, normal asset, whatever may be the classifications you have into the banking parlance, okay, whatever may be the classification, on all of these assets, you will have to find out the probability of default occurring over the next 12 months and based on that probability default, what is the cash shortfalls occurring over the entire life of the asset, discount it back based on the EIR, and that would be the expected credit loss for stage 1. Now, this is what is called as a loss allowance. Okay. This loss allowance, the minute you say it is an allowance, right, it has to be kept separately, you can keep it separately, and you can have fluctuations in that. In other words, today the loss allowance may be say 5 lakhs. In the next quarter, the loss allowance can come down to 4 lakhs, which means there will be a write back of 1 lakh in your books. So it is not a one-way traffic. Whatever you write off, it is not a write-off. This is not treated as a write-off. It is a loss allowance that has to be provided. So, and it has to keep, it will keep fluctuating. So the idea is, as far as the stakeholders are concerned, the investors are concerned, the investors will have to know at every point of time, whenever the accounts are prepared, what is the the likelihood that there could be some default in collections, and how it would impact the financial assets, and how it would impact the P&L. So this at any point of time the investors should know. So in other words, right, it is not as if you suddenly you say everything is fine, okay.
So through P&L or OC?
It's all through P&L. It's all through P&L. It's all through P&L. Okay. Now, so suddenly, everything is fine. Then suddenly, on 31st of December or 31st March, you say, there is a huge loss on account of this. Right? That's no point. So you'll have to keep informed. So even if there is a deterioration, you have to keep informed. If there is an improvement in the credit risk, that also you will have to keep informed, and then accordingly you will have to reverse it, right? So this is what is called a stage 1. Stage 2 is where the credit risk increases significantly. You will have to obviously provide more. Why you are providing more? Because you will have to consider the probability default occurring over the entire life of the asset and so on. Now, on both these stage 1 and stage 2, the interest revenue, because it is an asset, you will have to get some interest, right? There is only interest revenue there. So the interest revenue will be computed on the gross value of the asset. That means before considering the impairment loss allowance. So let us assume that your value of your portfolio is say 100 crores, and the loss allowance comes to some 2 crores. You will have to compute interest income on the entire 100 crores and not on the net 98 crores, right? So this is before considering the loss allowance on stage 1 and stage 2. Stage 3 is where it actually defaults. Stage 3 where it actually defaults. When it actually defaults, you will have to consider the interest income on the amortized cost. Here the amortized cost is defined as the gross value as reduced by the impairment allowance. Supposing, because it is default, like for example in this portfolio, the value of this portfolio is say 3 crores, and the loss allowance, let us say, is 2.5 crores, okay, because it has defaulted. So you will be computing interest revenue only on the 50 lakhs, because that is the amortized cost, which is the gross value as reduced by the impairment allowance. Is it clear? Now there is this movement of the financial assets from stage 1 to stage 2 or stage 2 to stage 3, stage 3 to stage 2, etc. It can happen freely. It can move back and forth. So which means if a particular asset is defaulted today, it can also become regular. That means the credit risk can improve, and it can move into stage 2, it can also move into stage 1. So that can freely move from one stage to the other stage. There is no bar. Okay. There is one thing called the POC asset. POC asset means purchased or credit impaired asset. This asset is purchased or credit impaired. That means at the time of purchase itself it is already credit impaired. It is already impaired. Like for example, you can probably find, this happened in, I can give an example in 2008. 2008 after the financial crisis. Okay, 2035 bonds issued by Citibank, $100 bonds issued by Citibank were available for just $2 or something like that, right? Such a deep discount. So that means why it has already become junk. It has already become a deep discounted bond. So those kind of bonds are credit impaired. Already it is credit impaired. When you buy itself, it is already in stage 3, right? So on such this thing, even if the credit risk improves, right, you will still be accounting for this only on a stage 3 basis. That means even if the credit risk improves, you will still have to treat it as if it is a stage 3 item only. So that is the only exception. Otherwise, it can move freely from stage 2 to stage 3 to stage 2 and so on. Now we will see some practical methods also.
This credit risk is to be assessed for each loan's account separately or the company as a whole.
Yeah. So see, as far as this credit risk is concerned, the requirement is you have to assess it on an individual basis, individual asset by asset basis. Okay. But if these assets have similar risk characteristics, then that will have to be grouped together and you have to make a group assessment. Like for example, I'll give you examples for both. Okay, you have given a project loan to company A. You are a company. You have given project loan to company A, and you have given a project loan to company B also. So both these project loans will have to be evaluated on an individual basis. Right? Let us assume you are a housing mortgage company. So you have given mortgage loans to 1,000 individuals, each 20 lakhs, 50 lakhs to purchase houses. And these people are situated, some of them are in Maharashtra, some of them are in Tamil Nadu. Let us assume these are the 2 states you are financing. Then you can say those of these loans which you have given in the state of Maharashtra can be grouped together because they share a common risk characteristic. If something happens to, there is a water problem, I'm just assuming, okay, just some examples, don't take it seriously. So there is a water problem in Tamil Nadu region, okay, they are more likely to be affected and have an impact in the repayments, right? Whereas it may not be so. Because of huge rains, right? Maharashtra may be affected because of rains, so there could be so you can probably classify these two as groups based on the geographical location, where if you think that is a representative of where the credit risk characteristics are shared, then you can group it like that. Like for example, there was a cyclone here in Tamil Nadu, and because of that certain districts were affected. Gaja, there was a Gaja cyclone was there. Because of that, there were certain districts were affected. So you can probably group those districts which are affected by Gaja as one group, because the repayment characteristics of those are more likely to be similar, and have that as a group, and then assess the group performance as compared to the rest of the group within Tamil Nadu. I'm just giving some examples, right? Does it answer your question? Okay, so see, the model is forward looking. So you have to consider the historical loss. You will also have to consider the forward looking information. So what are the forward looking information? There are about 300 data points that are published by economist intelligence group, for example. Okay, And there are a lot of such data points published by Bloomberg, Reuters, and so on. So some of these include, the gross domestic product, of course the risk-free rates. Then you have the unemployment rates. So all of these are some macroeconomic indicators which are likely to have an impact on the collectability of these loans. So those are the things that you will have to consider. So you have to consider what is the current state today, and what is the projected numbers for all these data points, and then say to what extent it is relevant. Does it have an impact on the on the collections, or does it, in the past, has it been proved that these variables have an impact on the collectability? Okay, so you'll have to study that. If you are able to have a statistically significant relationship, right, by applying a regression test, multivariate regression test, then you know that it is a statistically significant relationship. Then you will have to consider that and then compute how much it's going to be in the future. So that is what is called as a model for forward-looking model. I'll give you some examples of that. Okay, we'll see some examples of those. Now there is only one impairment model for all. Now the scope all the financial assets, debt instruments. Now see, this is also applicable for the FVOCI debt instruments. Okay, that's the only point I want to clarify. Somebody asked in the T session also. So this FVOCI debt securities, we are valuing this on a fair value basis, but even then we will have to do the expected credit loss on that, because what is not considered is the default risk is not considered in that. Okay, so that is the reason why we will still have to do that. While we are considering the interest rate risk and certain other risks, the default risk is not considered while doing the fair valuation of that. So equity investments, loan commitment measured at FVTPL. So all of those things are out of scope. Okay. Now, see, one important thing I want to tell you is that, see, this expected credit loss is new to accountants. For us, it is all new to us, but it is not new for the bankers. Okay, because this expected credit loss has been there in Basel. It is already there. Okay, so there it is defined as the PD into probability of default into loss given default into exposure at default. PD into LGD into EAD. That is how it is defined. But please note, that is not the definition that is given as per IFRS. As per IFRS, the definition is the present value of the expected present value of the cash shortfalls. ECL is the present value of the expected cash flows. It is not defined as PD into LGD into EAD. Okay, but I want to make it very clear to you. It is not defined like that. Okay, you may finally arrive at based on these factors, but that is not the way it is defined. That's what I want to tell you. That is not the way it is defined. So cash shortfall is the difference between the cash flows due to the entity in accordance with the contract and the cash flows entity expects to see. So contractual cash flows and the expected cash flows. The difference is the cash shortfalls. Now the loss model is very simple. 12-month expected credit loss or lifetime. So it is 12 months for all assets, lifetime if the credit risk increases significantly. Now the credit risk increasing significantly, there is no such definition there. There is a rebuttable presumption that says that if the default days or the DPD, days past due, exceeds 30, then you can say that the credit risk has increased significantly. Similarly, for default, the DPD or the rebuttable presumption for the DPD is 90 days. So that is the same as what you have for NPA also, right? For NPA, we say if it is 90 days, then we call it as a non-performing asset. So, definition of significant increase in credit risk, there is no definition. Entity uses the change in the risk of default occurring over the expected life. That is what is given there. And whether the risk of default has increased significantly, there is a rebuttable presumption that if the DPD exceeds 30 days, then it is credit risk has increased significantly. Okay, it's a rebuttable presumption. So which means if you have to rebut, then you will have to come with some statistics, with some data stating that even though the DPD has increased by more than 30 days, it is still not the risk has not increased significantly. You will have to come up with some statistical data to prove that. Otherwise, you will have to go by this. Similarly, for default, there is no definition. Each entity should do so. There is a qualitative indicators, breaches of covenants to be considered, all those things. Okay, and the standard contains a rebuttable presumption that default does not occur later than 90 days past due. So if it is 90 days past due, it is defaulted. That is the presumption. So these are some examples of the credit impaired assets. So we call credit impaired. So what are the instances? These are some examples. Again, this is not something that is cast in stone. These are some examples. So there could be other events that may still warrant the asset to be considered as credit impaired. Significant financial difficulty of the issuer, breach of contract, lender having granted a concession that would not be considered otherwise. Right? The borrower is likely to enter into bankruptcy, disappearance of an active market, purchase of financial asset at a deep discount. So whenever it is available at deep discount, you can say that it is already credit impaired. Now, let me able to see cash shortfalls, entire life cash shortfalls. So probability of default occurring over the next 12 months, but the cash shortfalls occurring over the entire life of the asset, the present value. So here this is you will have to do the present value based on EIR. Based on the effective interest rate. Okay, so that is stage 1. Now stage 2, I will run the same thing. Stage 2. In stage 2, the probability default is also to be considered for the entire life. Now stage 1 and stage 2, the interest revenue is calculated on the gross value of the portfolio, whereas on stage 3 it is calculated on the net value. Otherwise stage 2 and stage 3 is the same. Okay, stage 3 also the entire life of the asset is considered for considering the PD, probability of default. So the same thing is what is given here. Stage 1, stage 2, if the credit risk increases significantly. I have already explained, you can just have a go through that. So this is also on the gross carrying amount. That means before adjusting the loss allowance. Stage 3. If the credit risk increases to the point that is considered credit impact, then full lifetime credit losses are recognized. Same as stage 2. But the only difference here is the interest income is to be computed on the amortized cost, which is nothing but the gross value as reduced by the loss allowance. Now this collective assessment. So to your question, so the financial
Small doubt. In stage 3 that you said you need to compute the impairment based on net value.
yeah.
So already the asset is there and we are already recognizing the provision, that is the allowance. So basically you are saying transfer that allowance to the asset and then
Yeah, I mean, see, allowance is kept separately. We don't normally transfer that; it is kept separately. Okay, allowance because that keeps fluctuating, right? But when you consider you'll have to, of course, interest income is always calculated on a line by line basis, right? So for one particular financial asset, if it is a 10 lakh is the amount that you need to collect, right? You need to receive 10 lakhs is your gross value. But then the impairment loss allowance because of calculation of this ECL works out to say 9 lakhs. Then you will be calculating interest income only on 1 lakh, not on 10 lakhs. But if the entire 10 lakhs has to be provided, right, because it is defaulted, your ECL computation tells it is entire 10 lakhs, then you don't provide for any interest income at all.
Still it has to be highlighted.
Yeah, all this is disclosures you mean. Yeah. So the collective assessment, see all the financial instruments, financial assets will have to be grouped based on the common risk characteristics. Okay, so that is the basic requirement for all. Because some of these things you will have to compute the credit risk only on a group level, not at an individual level. It doesn't make sense to do it at an individual level. For example, your mortgage loans, right? You can't compute on an individual because you will have to do it only on a collective basis. You will be able to find out what is my historical loss experience. But if it is a project loan running into say 500 crores, right? Then you will have to find out how the credit rating has moved. So it will be a rated entity. You have funded 1,000 crores. It will be a rated entity. You can always find out how the rating has moved. Credit rating has moved. Right? And I will give an example how you can find out that probability of default using that. Okay.
This grouping differs every time you do the calculation.
Yes, perfectly. Yes, it can differ. It need not necessarily differ, but it can differ. Yes, very valid point. Yes. Like for example, I said, this time Gaja was relevant, or maybe last year, whatever, right? After 1 or 2 quarters, it may not be relevant. There could be something else, right? There could be something. Not like Gaja. I didn't mean that. What I mean is there could be some other criteria, new variable, which will enable you to classify that differently, right? Okay. So see the point in grouping is very very important point. This grouping is an amazing point. See, you should not group this into very very finer groups in such a way that you lose the collective performance behavior, so to say. Okay. So what I mean is the grouping has to have a normal distribution. So the grouping should eventually have a normal distribution. If you group it further, the distribution will be skewed. You may not get the right number. Okay, that's what I mean. This is not given in the standard. Okay, this is given in the basis for conclusion. The whole amount of logic behind the grouping, how it should be grouped, all these are given in the basis for conclusion. So that's where Okay, it's not mentioned in the standard as such. So shared credit risk, some examples of this shared credit risk: instrument type, credit risk ratings, collateral type, geography. Okay, so geographical location, industry, remaining term to maturity, the date of initial recognition is called as vintage analysis. You do a vintage analysis, so you find out all the loans that are originated in 2008 perform in a particular way. Loans originated in 2009 perform in a particular way, like that, right? So vintage analysis. So all of those things are credit risk modeling. It's all part of the credit risk modeling. See the probability weighted outcome. So now here you need to have at least 3 scenarios. Now the standard talks about a minimum of 3 scenarios, and these 3 scenarios should be, you will have to take the probability weighted average of these 3 scenarios. Now these three scenarios, please do not imagine that one scenario has to be an optimistic scenario, another scenario has to be a pessimistic scenario. No, that's not what is meant. Okay, so all see, there is a basic scenario which is based on whatever is the actual data. That is a basic scenario. Assign a suitable weight for that. Then the other scenario can be an optimistic scenario. Third scenario can be even more optimistic if that is what is going to be realistic. So we don't mean an optimistic or a pessimistic scenario. Now the way it is done normally, I'll tell you how it is done in practice. Okay. Now I'll take one particular variable just to give an example. Okay. Let us say unemployment. Okay. We will say current. Let us assume, okay, this is what has gone into my assessment of the current situation of unemployment, okay, current unemployment. Now, the economist tells you that at the end of the next quarter, that is on 31st of March, as per the published data, okay, it's all paid, economist is paid. Now, let us assume that it's going to be, say, 2.85. Okay. So this is, I will assign more probability for this one because this is coming from an authentic source, from a source, and I would imagine that this will have a higher probability of occurrence. So the current base scenario, I will take it at 30%. This one I will take it at 50%. Because it is what is published. Then I will take a contrary view. It need not necessarily be 2.5, right? So it assumes that by basis points, 45 basis points, the unemployment goes down by 45 basis points. I may assume that the unemployment can also go up by 45 basis points, right? So that will be 3 points. I will assume a lesser probability for that, right? So this is how it is. So it need not necessarily be. You can say, okay, I can assume the economy may become even more rosier because of the various measures, budget, blah blah blah, whatever it is. I am not representing any political party. I am just saying it can be better. Let us assume. Then you can say, this is another scenario, 2.5% maybe, 2.5% basis unemployment can be another scenario. So you can assume, so this is a judgment, you have to use a judgment, right? Based on the judgment, you will have to assign. So now the important point here is that the final number ECL will be probability weighted based on this one, okay? Then as far as US GAAP is concerned, in US GAAP, they do not want you to have multiple scenarios. So you have to find out the highest possible occurrence. That is what is taken. Like for example, you have these 3 scenarios. The highest possible is what? 50%. You will have to take only the 2.85 there and show. scenarios, CCAR and other regulatory bodies require you to do some stress testing with these scenarios. That is different, but not part of the ECL, not from an accounting point of view. From accounting point of view, you have to take only the best case scenario there. That is the one which has the highest probability of occurrence alone has to be taken, whereas under IFRS you should have a minimum of 3 scenarios. Okay, that is important. You have to have a minimum of 3 scenarios. Forward-looking segmentation, I explained. So appropriate grouping is very important. See, no specific method to assess the credit risk. See, the ECL, if you ask me what is the method that should be adopted, what is the method? Is there any method that is given? No method mentioned under IFRS. Whereas under US GAAP, you have 6 methods that are mentioned. Discounted cash flow, transition matrix method, loss rate method, roll rate method, PD/LGD. 6 methods are mentioned there. Here, no such methods are mentioned here. Okay. So this is completely principle based. So it has to pass the common sense test. It has to pass the statistical testing and so on. So the term expected, as used in the terms expected credit loss, expected value, expected cash flow, is a technical term that refers to the probability weighted mean of a distribution and should not be confused with the most likely outcome or an entity's best estimate of the ultimate outcome, which is what is referred in the US GAAP. Okay, that is a very significant difference. Cash shortfalls, the macroeconomic indicators, these are some of the macroeconomic indicators. Okay, fine. So, how much more time we have? We have till 5:30, no? Huh? 5? 5:30. It's actually 6, no?
5:30.
No problem.
I mean,
6 o'clock. 6 o'clock.
yeah. If it is not boring for you, I will continue, no problem for me to continue. Okay, now I will give some examples, okay, for this one, practical examples. We will say some case studies. We will take project loans, right? So there are different project loans that are given. Now, there is a method called a transition matrix. This is not specifically mentioned in the standard, but this is mentioned as one of the methods in US GAAP, transition matrix. Now, transition matrix, this is the 2 scenarios, okay? Case 1, case 2. Don't confuse this with the 3 scenarios that has to be, no, these are 2 separate problems, 2 problems, not with the wrong word to use scenarios there, okay? Because you will be confusing this with the 3 scenarios for each one. So this is case 1 is one case, case 2 is another case, okay? Now the credit rating, so project loan outstanding is 23 lakhs. The recovery rate is 25%. So what does it mean? It means that if you have to collect, then you will be able to recover only 25%. Because normally, for project loans, the recovery rate is actually 0. Because it will be an equipment that is tailor-made for the particular project. So it may not have any resale value, but there is no harm in taking 25%. Okay, that is the industry practice. So you can take 25%. Then, so that means the loss given default is the difference between 1 minus recovery rate is the loss given default. Date of acquisition, that is the date on which you have given the loan. That's the date of origination or acquisition. The maturity date, 31st March 22. Valuation date, 31st March 19. We are going to value this as 31st March 19. Balance tenor to maturity is 3 years, because we still have 3 more years to run as of 31st of March. So the credit rating in the first case is AA, and on the valuation date the rating is B. That means there is a significant reduction or the significant increase in the credit risk. So the significant increase in the credit risk means we need to consider the probability of default occurring over the entire life of the asset. Right? Okay. Now the loan is appraised by CRISIL, and the credit ratings for the respective things, we have the credit rating here. Okay. So for case 1, we have the transition matrix. Now what does it mean? This means that, let me take this. See, the currently, okay, the project, are you able to see here? Are you able to see this? Okay. The loan which is, there is a 95.22% probability that this loan will continue to remain in AA rating at the end of the 1 year, at the end of the first year. There is a 95.22% probability. There is a 1.47% probability that it will move, it will improve to AAA. How do you arrive at this one? This is arrived based on all the loans that CRISIL has funded in the last 10 years and how it has performed. They know the actuals. It is all based on the actuals. They know currently what is the rating. At the end of the year, they know what is the rating. So they know, they can find out how it has transitioned from one period to the other period. Is it clear? So the probability that it can get worse from AA to A is 2.82. That it can get worse to triple B is 0.49. This is based on actuals for the last 10 years of all the project loans that CRISIL has funded. This is a public domain. It is available in public domain. It is not an imaginary number. It is taken from the public domain. So like that you can find out for the various ratings. Now, what is the rating? This was rated at AA, right? AA, no? Initially? Yeah, so AA. Now it has become B. So you will have to find out, currently it is B. That means currently B staying in B is 83.11. B becoming D. What is D? D is default. So there is a 8.27% probability. There is an 8.27% probability that this will get defaulted at the end of the first year. Is it clear? That is the interpretation. The interpretation is there is an 8.27% probability that will get defaulted at the end of the first year. But we don't want the probability of default for 1 year, which is 12 months, but instead we want the probability of default for the entire life. What is the entire life? 3 years. No, 4 years is, 1 year is already gone, right? So we only have another 3 more years to go. So we need to find out what is the probability of default occurring over the next 3 years. So this transition matrix will have to be raised to the power of 3. You will have to raise this matrix to the power of 3. So you will get how much it will be. So you will have to do a multiplication, matrix multiplication, and based on that you find 3-year matrix is, double B rating becoming D is 10.61%. No? Oh, sorry, B, it is B, no? 21.91%. Is it clear? So from 8.27, it becomes 21 points. So 3-year probability, 3-year lifetime default probability goes to 21 point. Right? So 21.91 multiplied by the amount outstanding, which is 23 lakhs. So that will be the total this thing. That multiplied by what is the loss? The loss is only 75% because 75% I am going to recover. So multiplied by point this thing. So you will find out that is your ECL for one scenario. Like that, you need to find out weighted average. You have to construct 2 more scenarios, okay, and then find out what will be based on the weight you have to find out. So that, right? Now let us see the next case, case 2. Case 2, initially it was B, now also it is B. So 1 year transition matrix. 1 year transition matrix is 8.27 only. 1 year PD is 8.27. So multiplied by 8.27. So it will get 140. Is it clear? So this is for the project loans. Now let us see the discounted cash flow method. Okay. Now I am trying to cover 2-3 methods for you so that indicate you. Now here this is based on discounted cash flow. So forget the assignment of this probability. I have assigned 50%. It's judgment call. You can call it 20%. All the 3 put together should be 100. Ensure that. It can't be 110. That's all. So 23 lakhs. Discount rate is 9%. Discount rate is actually your EIR, the coupon. That is your coupon or your EIR is 9%. Then the default probability is 6%. PD and LGD are given. Okay, 24% is the loss given default. Then the monthly default rate, monthly discount rate, monthly coupon rate you arrive at, the net rate, principal outstanding 23. Then you find out, see, based on applying the regression analysis, it was found the 2 additional scenarios should be considered, one with a PD of 8%, another with a PD of 10%, etc., and assign different probabilities. So that is part of the question. Now how do you arrive at this number? So you have to find out the cash flows. So there are going to be 10 cash flows, and for 10 cash flows you find out what is the payment, what is the default. You have already the numbers, you have the default numbers, you have the loss given default, you have the recovery. So you find out what is the fair value, discount it and find out. So the present value of all the cash flows after considering the probability of default and the recovery works out to 22. So that means your expected credit loss for this particular scenario is 16,240. Similarly, based on the next one is based on these different parameters of 8% is the default probability. Based on this 8%, again work out the cash flows because it's the discounted cash flow. Work out the cash flows and find out what is your credit PV. And so based on 8%, based on 8% it is 21,000, and based on 4% it is 10,000. So arrive at the probability weighted average of all this. So I have assigned the different weights. So you can have your own weights here. So the weighted average 14,608 will be the actual ECL that will be computed. Right? So this is one, and we have for receivables. See, for receivables, there is a different treatment that is allowed, because for receivables it is not as if it runs into several years. So then if you say find out what is the 12-month probability, what is the lifetime probability, because the lifetime itself will be only 6 months, so it doesn't make sense. So the standard provides a much simpler way. Previously we used to do it based on a provision matrix, right? We used to do a provision matrix. We say, okay, if it is up to 30 days, 2%, 30 to 60 days, 5%, 60 to 70 days, 7%, above 180 days, like that we used to do arbitrarily, and the auditor will be highly satisfied. Okay, I expect at least 10 lakhs to be provision. The client says 15 lakhs, okay, no problem, 15 lakhs, okay, let it be. So you will be very happy. Okay, so now that is not possible. Okay, now it is not possible. If it is, you have to find out what is the basis for arriving at these numbers, these buckets. So in these buckets, how did you arrive at these numbers? It has to be based on a scientific method. So you have to find out historically what has been my loss percentage. There are totally 4 methods for receivables. Okay, I'm going to do only one method. There are 4 methods. 4 methods are there. These are simple methods. Okay, all the 4 are very simple methods, very logical. Okay, nothing complex, no mathematical model here and all. Very simple methods. So you have to find out what is historically what is my loss percentage based on how much you have actually incurred, what is the loss that is incurred actually, considering a particular sample period. The sample period should be representative. You can say, okay, in the last 2 years, what was my billing? And how was my collection? Whether I am able to collect within 30 days, 60 days, 80 days, etc. Bucket it to the collections also. Find out what is my balance. And that balance, find out what is the percentage of the loss incurred during the 2-year period as compared to the balances appearing in the respective buckets. Find out that, convert that as a percentage.
Once more, sir.
Huh?
Once more.
Okay. So you find out what is the total billing that you have made, and you know the billing, and based on, you also know what is the collection that is made. So your bill today, when were you able to collect? In the last, this is a data for the 2-year period. It can be 2 years, it can be 3 years. Normally it is anywhere between 2 to 5 years. It has to be representative, right? One particular year the collection is super collection, so don't take only that and then work out to give a rosy picture. No, you have to have a representative year. So 1 year the collection was awful, another year collection was okay, 3rd year collection is super good, or take all the 3 years. All the 3 years and then arrive at the balance. Okay, this has to the auditor, you have to satisfy the auditor, stating the auditor should be happy with the period that you have taken. That's all. Find out the total billing, find out the collection periods. So find out how much was collected in the respective buckets. Respective bucket, by bucket I mean the aging. Okay, so 0 days, 0 to 30, 30 to 60, etc. every 30-day buckets. And then find out what is the balance due from the total billing made, what is collected, what is the balance, right? Find out what is the total amount that is written off, you have not been able to collect, that is written off in the books, not provided, written off. So what is the amount that is written off? Find that as a percentage of the collection. That is the percentage that you will have to provide on the current outstanding receivables. Then it becomes a logical, it's not an arbitrary number, it is based on your past performance. But then you have to consider the forward-looking information also, right? So based on the forward-looking information, you find out, run a multivariate regression test. You take 3 parameters, find out the coefficient of correlation, the regression, it has to pass that regression test, you have to have a specified F value, P value, etc. R squared should be greater than 5, all those conditions are there. You have to take all these into account, and if it passes that, it is statistically significant. In other words, what I'm trying to do is to find out whether the independent variables, okay, here the independent variable is your receivables balances, okay, and all the dependent variables, right? The dependent variables, the dependent variable is your receivables, and the independent variables are your various macroeconomic factors. Find out whether there is any statistical significance. If there is a statistical significance is there, then find out what would be my expected loss. So you have already written off some loss, so that what would be my expected loss? So your actual loss is say 1 lakh. Based on these forward-looking information, your loss will not be 1 lakh. It will probably be 1,25,000 in one scenario. In another scenario, when you tweak the forward-looking information, the loss is 90,000. 90,000 in one case, 1 lakh is your base scenario, 1,25,000 is another scenario. Okay, 3 scenarios you've got. Convert this into a percentages, okay, and apply that to the actual receivables at the end of the day, and find out what is your ECL. Assign weightage for all these 3 scenarios, get the weighted average probability. That's how it is. This is one method. Okay, there are other 3 more methods are there. There is also roll rate method is there. Okay, there is also a transition matrix that is possible for this one, which is different from the other transition matrix what I explained before. Okay, we will see this. So this accounting policy choice. So here for lease receivables and trade receivables, etc., you have what is called as a simplified approach. We will see what is the simplified approach. The first step is you have to group this according to the assets that are having common risk characters. For example, you have different sales regions, or you have different sales products. For example, you have leather products, you have hosiery. So hosiery can be one group, leather can be another group, or sales to Maharashtra and sales to Tamil Nadu can be one group. Okay, like that you will have to decide which one represents common risk characteristics, and then segment it accordingly. Once you segment it, then find out, determine the period over which the historical rates. So you have to determine the period. It should be representative. As I said, it could be a span of between 2 to 5 years. Then find out the historical loss rates. Then consider the forward-looking macroeconomic information and adjust the loss rates. Then the fifth one is apply the adjusted loss rate to the actual receivables to arrive at the expected credit loss. Okay. I have given some example here. So here you have you are trying to analyze the data. So 2-year data, 2 years of sales information, okay, and you also have given the collection information, which is grouped based on the aging wise. So you have this is the base data, and you have the outstanding receivable as at the reporting date. That is the one on which you have to apply the historical loss to arrive at the ECL. So all the information is available, then you need to do the working. So first compute the loss rate. So find out from the total sales, what is the balance outstanding for every bucket, and then apply this 4,75,000, which is the loss that is written off, and compute that as a percentage. So that is your historical loss rate, and adjust that historical loss rate. Now here what I have done is I have simply added a percentage, okay, based on forward looking information. I just added 0.25% and apply that, and that will be your ECL. Similarly for the other region, you do the same thing for the other region. Here the macroeconomic data could be different. It could be 0.5, it could be even minus, not necessarily it should be plus, right? One scenario can be plus and minus, and that is how you compute it. It's exactly 5:30, 2 minutes to go, so 2 minutes for questions.
If the company is a new company where adequate backup data is historical data is not available, how to
see what we normally do in that case is, we consider equivalent data available in the public domain. Like for example, if it is a housing loan, right? So we have housing loan performance available in public domain. So you take that and apply that. So that is possible. And again, see, the historical data is only one. It's not the entire thing, right? So there are different other methods by which you can find.
The profile of the borrowers are different in this organization. It cannot be equated with the statistics available in the public domain. Perhaps HDFC may be having the highest standard, LIC Housing Finance may be having a better standard. The new company, the profile of the borrowers cannot be equated. In those cases, whether I am justified in applying the...
See, historical, you may not have historical performance for the particular company. It is only, okay. See, first thing is basically we need to have historical data, right? If it is a new company, normally what is followed, in India, we don't have much of this information that is available in public domain, okay? But if you take the US market, right, you have all the historical performance for the last 20 years, from 2000 onwards it is available. And the performance of that will invariably be the same because they have the same yardstick, right? So, historical data is not the only consideration, okay? there could be other, there could be other considerations like the rating of those individuals, okay, to whom it is given. So what was the rating at the time of issuance and what is the rating currently? Those things can be taken. There could be multiple methods by which we can work out on that. Credit score, CIBIL score. Any other doubt on this application? Okay, thank you. Thanks a lot for your kind attendance.
Let us put our hands together for sharing his wonderful experience and knowledge for the benefit of all of us.